I was literally picking individual large cap stocks on a $2 billion fund and really got to understand so much about Wall Street, how it works, supply, demand, valuation, and all this stuff. You're basically saying, fine, tax me, but you're not changing my cash flow. I'm going to use the policy itself to pay back Uncle Sam. You gave me a deduction for this. I'm going to use the assets that you let me deduct to pay you back.
If I die early, the last place in the world where there is allowed to be any uncertainty is that my wife and my daughter's life doesn't have to change financially if I'm not here to earn. If there's any leaks in that dam, nothing else I do matters. All right, welcome to Remnant Finance Podcast. I've got a very special guest here, Rohit Punyani. Did I say that right?
Yep, I go by Ro. It's Rohit, but I go by Ro.
Yep. Okay, cool. All right, Ro. We're going to be talking today about something that I'm really excited about. This is going to be geared primarily towards our business owners. But hopefully, if you're not a business owner, if you're listening and you don't have a tax entity yet, I hope with our previous calls with a tax strategist, we've stressed the importance of trying to find a way that you can create a tax entity. A lot of our military clients, if you're just W-2, this is another check in the box for why you should explore how you can provide value and create a taxable entity, because this strategy is geared primarily towards business owners. But let's do a little background introduction. Let's talk before we get into the strategy we're going to talk about today. Ro, who are you? Where did you come from? What have you been doing before this? And what do you do now?
Okay, who am I? Like very existential.
Yeah.
So like we're starting really deep. We're going straight for it. So first of all, I did make sure I put some product in my hair because I had the 70s Bollywood thing going on if I didn't like put the product in, right? So who am I? I've been in financial services for over 20 years. One of my first jobs out of undergrad was at a mutual fund and in late 04, early 05. And candidly, that was one of the best and most informative experiences of my career, Hans. I was literally picking individual large cap stocks on a $2 billion fund and really got to understand so much about Wall Street, how it works, supply, demand, valuation, and all this stuff. And 08 came and you see, whoa, there's so much more fragility here than you think. And 08, everyone says is, such an outlier. No, it's not. And we'll go over history of markets and stuff later. And I kind of looked at that and said, okay, well, we saw these outflows. I said, let me go to grad school because I really want to get on the social side of the business than just kind of being a spreadsheet dude my whole life, right? So I went back to grad school at Georgetown where I did my MBA, and it's just about 5 miles up the road that way. And I wanted to move into wealth management and start working with high net worth clients. And I was really fortunate to hook up with Wilmington Trust, probably one of the best brands in the space. And I really got to see how investments is just a smaller part of planning, right? Planning is the intersection of 5 pillars, as you may or may not, kind of know, Hans. It's tax, it's banking, it's investments. It's all of the major pillars of wealth. And I used that opportunity to get opportunity to be chief investment officer of a multifamily office and then ultimately a community bank where I oversaw $4 billion. So deep Wall Street background. And then I think the question you want to ask me, Hans, is how did you come to life insurance?
I do want to ask that, but I want to talk a little bit more because what I want to emphasize is that our audience knows we love whole life insurance, and they know how we came to discover is not the right word, but how we came to accept and understand and implement this process for ourselves, for Brian and I, and now what we do for our clients. That's not new to anyone listening to this. But what is new, I think, would be how someone comes from a finance background. And I also want to hit on the estate planning background, because my goal for this to be the first of hopefully maybe 5 interviews that we do. And we've got so much to talk about. There's going to be hopefully an entire estate planning discussion specific to how this ties in. And I also, I'm knee deep in estate planning right now for the CLU course. And so that's top of mind. There's so much I want to talk about there. I want to stay away from that mostly, but can we talk a little bit more about what you saw on the investment side? And are you in DC right now? Is that?
I'm technically in Arlington, Virginia, because the DC folks are purist if you're in DC or out of DC, but it's about 5 miles away.
Okay.
Yeah.
Gotcha.
So what I saw, and it may not be the direction you want to go, Hans, but what I saw is how my most affluent clients think. They do not think in terms of, if I have two opportunities and opportunity A has a higher IRR than opportunity B, I'm taking opportunity A. That was really never part of the dialogues that we had. It was, okay, let's compare them from a structural perspective and let's compare them from a behavioral perspective. I really had to get sharper and became, I think, a student of behaviors and behavioral finance, working with 100 millionaires and billionaires. And what does that mean? Structure first. Anytime they could move the goalpost to tax efficiency or optionality, they did. That was so much more interesting. Okay, I can make an extra percentage, but I got to lock up the capital for 10 years in this VC opportunity in this private equity fund. They would tend to stay away from that because liquidity is paramount. Staying power is paramount to these individuals, right? Optionality was also, how do I title this? Where do I move this? If it in Try to link it to estate planning a little bit, but maybe we do a different episode on that. If they knew it was going to be a high appreciating asset, they would freeze it at current cost basis, move it out of their state, and get the appreciation because their liquidity becomes less important. So they were always thinking in terms of a chessboard. And how did I come to life insurance from that? When I was the chief investment officer of both entities that I was astonished at how many affluent families loved this asset class. So it was basically a lot of data coming at me saying, the people you're serving are doing this. Just go get smart on it. Learn enough about it. Because when you grow up in money management, you're taught to worship at the altar of IRR. Stocks are at 9, life insurance is at 6 pre-tax, 7 pre-tax, depending on your state. Go for the 9, not the 7. That's the difference between,
Yeah.
visiting an island and buying an island over 50 years. Well, you learn that the behavior element matters a great deal more, which I hope to get into. But Hans, that's why I got into it. My wealthy clients were like, I'm doing this with this, check it out, Ro. And they were literally telling me, I'm collateralizing this to go buy an entire natural gas fracking facility.
Yeah. And that resonates, I would imagine, with most of our listenership. Our framework, how we position what we do, is not that we are investment advisors. It's that in the framework of protect, save, grow, in that order, which is kind of our primary starting point. The whole life asset is the optimal tool for the protection and saving side. It itself is not a growth, though I'll say if you fund a policy as illustrated for 20, 30 years, year over year, that asset will outperform, I would say, any investment you have on a year over year basis if we're looking 3 decades down the road. But that is not investment advice, and we don't do investment advice. We do protection and savings advice, and we really want to put that foundation in place. And it's interesting that when you were listing the things that wealthy people think about, when you were listing the pillars of wealth, investment was the third one that you wrote down. You said tax and banking ahead of investing. And I've got 2 high net worth friends, and one of the 5 episodes I would like to do is kind of a case study geared towards their 2 specific situations. Their whole life is dealing with taxes. Their entire data, like every decision they make, it seems like, is based on how do we deal with taxes and then estate tax down the road. That is such a critical part. And it's never, one is a real estate investor, one is a crypto hedge fund manager. They never talk about investment returns in the stock market like that. I don't think either of them own stocks. And if they do, it's advanced strategies that they're leveraging. It's nothing to do with just like buying index funds. And that is so contrary to what we grow up with, a lot of us, and just kind of the middle class, or we've got a decent, good W-2 income, or you're a military officer, and you're just told invest, ROR, ROR, ROR. What were your preconceived notions of whole life specifically going into your career before they basically beat down your door and said you have to explore this? Did you have like the typical marketing slogans against whole life that are so common, but going into it?
Yes, and that's why I think it took me so long to learn. So not only am I a little bit lower on the aptitude score, I think my standardized test will attest to that, right? But I was so biased against it when I was studying it, because I was told, poor rate of return, it's a scam, it's a Ponzi scheme, and you hear this stuff, and then you look at it and you say, okay, how can it be a scam when you are given a ledger of what's guaranteed to happen? Right? I mean, you're allowed to, from a compliance perspective, use the word guarantee in 3 categories with whole life. The premiums will stay fixed. That's a guarantee. The death benefit, right? And the non-forfeiture rate, the guaranteed rate of return. Well, when you're told explicitly what's going to happen and it's on a contractual basis, then all of a sudden, if you're honest and intellectual about it, you realize that, this may not be this probably gets a B or a B plus on the accumulation scale, but then it gets an A almost everywhere else, right? It's like the Swiss
Yeah.
Army knife of things. And so that was one bias I had to overcome. The second is is when you say, okay, trying to figure out what role it's going to play in your life. And that's what I think is so misunderstood about whole life insurance in general, but I'm a whole life guy, is you hear ideas about the role it plays and it's different for everybody. Your audience loves infinite banking and so do I, and I practice it, right? I work with clients who that whole concept of infinite banking is irrelevant to them. Rightly so. They're so wealthy that they're
Mhm.
just going to just leverage and collateralize other assets. They probably actually don't really understand what's going on because whole life is safer leverage. It's a different kind of leverage, but they absolutely need life insurance because it manufactures liquidity in their state. That's huge. Your example of a real estate investor is really interesting because real estate investors, should something happen, will end up being forced sellers of the property in an estate unless they create some liquidity. So what's hard about life insurance is it has a lot of uses, and if the first time or second time you interact it's not the use you had in mind, you dismiss it, and that's just unfortunate. I don't know a way around that from a advisor perspective.
Yeah. It's I almost view now this works in one direction because again I don't I'm working on my on my exams and I'm gonna get all the qualifications to stop having to say this is not financial advice. Um, I'm going through all that stuff right now because I'm sick of having to caveat that when that only seems to work in one direction, right? You can give bad
Yeah,
advice if you have the licenses, but you can't if you don't have them. And so I'm going to get them just so I can stop caveating. So I think you're not do. I don't think you're doing your fiduciary duty as a financial advisor if you don't deeply understand whole life asset. I think that's a bold statement because most of them just ignore whole life. It's like a nice to have. It's maybe get a little bit and then just get some term, and we're just going to focus on our ROR. But I just love that your background to this was, or your introduction to this was not starting from a place of trying to understand and like focusing on life insurance. It was you need to do, like your client saying you need to understand this because you need to provide better this service for us or what we're doing. And the high net worth friends that I have who are thinking about this, I do have a friend where all of the talking points for infinite banking, separating control, severing from control of Wall Street, all that, it doesn't apply when you have so much money that in his example, he can call Chase Bank and they'll deliver a box of cash so he can close on a property on the spot. Like that happened. I watched that. That when I say that, you have, leverage over your capital and guaranteed access, he's like, bro, I can get the same thing
right.
on a much larger scale at an even lower interest rate on demand the day of. Like it's not, so we have to think differently, but there is such a value here. With that in mind, we we can underscore the value of tax and bank. So we talked about tax. Let's talk about banking as well, and just that control feature. You listed that before investments. When you think of banking, what do you think of when you hear in the infinite banking community becoming your own banker? Obviously, we're not starting a bank. We want to take control of the banking function. Everyone, I think, defines that a little bit differently if you ask them. But what do you think of when you think of the banking function and what this asset can do in that realm?
God, I think of that across a couple of dimensions, but the first is I think the mission. I'm trying to use pilot terminology, right? The mission of a professional investor, the mission of a wealth builder, the mission of somebody seeking independence is to ask one question. If I need capital, what's the best way to source it? Now I didn't say cheapest, but we should get into that as well. And so I have no problem borrowing or collateralizing against a markets portfolio. And I still love markets. I do. I'm very active in that space, and we should talk about how they all coalesce at this or next episode. Here's what's so interesting. It really does depend on how you're sourcing that leverage. So typically, a margin loan against a portfolio, you could only go up to 50%. So that's the first limit. If you have an outsized event, they make you add capital. Neither of those are true for whole life, but even more interesting, it's the third element that not a lot of people understand is some of them do it some brokers do it by default, but some reserve the right in the paperwork and don't tell you if you are fully margined and you have a portfolio, say dividend growth stocks, one of my favorite ways to invest because I love cash flow. They can hold those dividends to hold that margin back at 50%. So now you have less leverage on a margin account than, say, a whole life policy, but you've lost control of your cash flow. That to me we became a really interesting argument of oh, maybe I should explore infinite banking, and I have done it, and I have policies in force, right? I have 4 in-force policies, and plenty of convertible term because I love it, because I wanted to figure out what is the best source of leverage.
Yeah.
Now, when rates were super low 5 years ago, I could borrow from my portfolio cheaper than I could borrow from my whole life policy. And interestingly enough, now that's starting to switch. We're seeing that those come back in vogue, back in line rather. So
Yeah. And that's just looking at one metric, right? That's what is the rate, the interest rate I can borrow at. And at
mm-hmm.
times that can certainly be cheaper in different assets. As someone big in the IBC space, one of the OGs, James Nethery, says you can collateralize anything. You can do IBC with a barn full of tobacco or a safe full of gold. If someone's willing to lend you for
Yeah.
collateral, you can kind of practice this, but mechanically there's nothing superior than the whole life cash value for that strategy. And so, yeah, you could borrow against your stock portfolio at a lower interest rate, but that comes with the stipulations of the bank is in control. The bank gets to make those margin calls. The
Yep.
bank gets to set the margin, all the things we just talked about. And it was interesting when you're talking about borrowing against your stocks. The Reg T is for just for your margin portfolio as an individual, right? That's where you can leverage your, leverage trading, right? Is that the same thing? Is Reg T also applying to when you're borrowing against your own stocks for a personal loan, or are you just talking about borrowing to purchase more equities?
Typically, yeah. So Reg T is broad, but yeah, you're when you borrow from margin, you can buy more equities with it. They just change the release rate there on it. But
Okay.
interestingly enough, when you borrow from margin and you were to go do something else, say buy real estate, you go through paperwork for the bank to approve what you're doing. Oftentimes, what you're borrowing for, whereas not the case for whole life as well. And that doesn't make it necessarily better, because there's another way to borrow, and wealthy clients instead choose a securities backed line of credit, which is another way to borrow, and you have a little bit more freedom, but release rates can change, and rates can change there too. So yeah, I like that there's an upper cap to my borrowing rate in whole life. So that's interesting from a borrowing perspective. What else about the asset that's interesting, for me from a banking provision? Even if I had a slightly higher rate and I was really lower rate on a securities line or margin line, and they didn't withhold my cash flow, knowing that the underlying asset's always going to go up, meaning my revolving credit facility that I'm creating is always going to grow, is a huge advantage, right? So yeah, it's basically a line of credit that grows in perpetuity and auto completes, and so that was appealing from that perspective for me as well. You asked a different question about how do I think about banking. So let me go there for a minute. Most of my policy loans are for venture capital right now. Those are illiquid and do not produce a cash flow. So tough, very tough. So how I talk about it with our clients, because we do some IBC, but we're not, experts like you. We play much more on the cash balance side. There's only two things you can do with money. Only two. You can buy an asset or you can buy a liability. And so we tell folks, if you're buying an asset, pay the interest only, because eventually that asset's going to come back to you or you'll sell that asset. So right now, I'm treating all of my IBC loans as interest-only loans. If you're buying a liability, pay it back like you're paying back your family. I mean, right? And that heuristic has really helped our clients sort of make decisions. Okay, well, how do I do this? When do I service it? When do I don't? They love the freedom, but then I'm finding our IBC clients are saying, and I love it because they're calling us, right? That's all we want as advisors, to help and to have an impact. Clients are calling us and they're saying, okay, I took a loan. What do I do? I said, whoa, what'd you use it for?
Yeah. That's
If it's an asset, you're okay paying the interest only. It's just hope that asset, not hope. Hope is not a good word, but did you do your due diligence on that asset, that it'll either produce a cash flow or it'll go up faster than your cost of capital? In which case, boom, private carry trade. Keep going, press on.
private. I love that. I love that you said that, because I frame that. That's exactly how I'm treating my policies at the moment. My wife's policies are emergency fund. What I'm doing with that one is, I know based on our current annual and monthly spend, I know how many days of runway I have with that. So I literally, that's our burn rate. That is if Remnant stops producing income, if we just want
Mm-hmm.
to take an extended, early, like mini retirement, something like that. I know how many days, literally down to the day of runway, that her policy gets for us. Now, I don't plan to just use that. Obviously, that is more of the emergency fund in the sense of like major
Yeah.
expense, right? But our savings component is primarily in my wife's policy. In my policy, not that this is an official distinction, just how I categorize things on my spreadsheet, my policy is solely for investing and growing. So every dollar I keep a a buffer there. I don't want to use the word margin because that's confusing in the
Yeah.
context we're talking about. But I keep a buffer of like, because I have a couple rental properties, and those are obviously prone to having expenses, and so I keep a buffer to keep it from being fully levered. But for the most part, the way that I describe it on our podcast is like those are my slaves, and they all need to be out in the field working 24/7. They don't get to rest. So I don't like the
Yeah.
idea of paying down my principal on those, and that kind of goes against the NNI Nelson Nash philosophy of like the way that he describes is like you need to pay yourself back with even more interest than you'd pay the bank. And I'd say, well, if it's a car loan, yeah, if the car dealership is going to offer me X% and I'm going to use a policy loan, yeah, I should pay myself back
Yeah.
more because every time when I pay back the bank, or sorry, when I pay back the car dealership on the loan, not only does all the interest go to them, but the principal also goes to them. Now, I could say principal goes to my car in that if they repossess the car and sell it at auction, I get a
Right.
little bit more cash back because I have a little more equity in the car. But equity in the car is not a real thing, in my opinion. And
Yeah.
so,
It's a depreciating liability. It's not an asset, right?
yeah,
It's unless you're an Uber driver, then it's your main. Like I get it, but it's going
it's
down in
cool. But
value.
like 100% of what I pay to the dealership is going to them, to their pockets, in my mind. But when I make a payment to my policy loan, I could mentally parse away some of that for interest, even though technically it all goes to principal, but I'm still generating interest. So I could parse out the same amount that goes to interest as I would to the dealer, but the principal component that I'm paying, all it does is just increase my available to borrow against. I'm just releasing the lien on my own capital. So I love the idea of if you're buying something like a liability, like funding a car or an expense there, yeah, pay it back and pay it back at a higher rate than you would pay the bank because that's when you prioritize your capital more.
Yep.
But if the bank were to offer me a guaranteed loan with no repayment schedule and I could choose to make it interest only, that's how I would treat the bank's money. I wouldn't, so what I do is I keep those slaves working in the field for me. They don't get a break. When I pay premium and I have more cash value, I take that cash value out and put it in an investment because they need to be doing more than they're doing in the policy. That's how I view it as well. So I love that you didn't use a slave analogy, and I think I'm the only person in the IBC space that regularly makes an analogy to
Yeah,
slave
I'm going
owning.
to stay away
But
from that analogy. I'm going to say like
yeah,
teammates working in the field. I'm going to stay away from that, just obviously
yeah,
for obvious reasons. But yeah, so yeah, we're very aligned on that, and I think what we do at the Owner's Asset, my company, is it turns out there's a couple of ways to get life insurance with pre-tax dollars, and
yeah.
our approach, our focus on it is cash balance plans, and I know that's something that we wanted to discuss. So, did you want to go there next, or did we want to finish anything on IBC?
No, that's awesome. I think let's pause on the Wilmington Trust. I do want to come back to that when we talk about estate planning. Estate planning will come up in a high net worth client case study episode, and then obviously in an estate planning episode. I could talk your ear off because I have questions for myself for my own learning as I'm going through it. I don't want to necessarily avoid estate planning conversations if it comes up today, but primarily let's talk about the plan that you offer and then how you came to tie life insurance in with this plan, this section of the tax code effectively that we're talking about. What are we talking about?
Yeah, sure. What are we talking about? Great. And I've done this, before. I have a kind of a standard 2 or 3 minute explanation piece on this that I have found has resonated. What I care most about is if I get in the weeds or it's not landing, Hans, jump in and interrupt me. Cool.
I live in Weeds, so
Okay. So what I like to do is whenever we're learning anything new, whether we're a scientist or a physician, anybody, we're learning something new, and we need to learn to relate it to something we already know. And so what I do is I relate cash balance plans, or what they're called, to 401ks. I just think so many, and in your world, in the military world, it's the TSP, right? It's the the thrift savings program for federal government employees, and those are the same. So people actually already understand the overwhelming majority of what a cash balance plan is. A cash balance plan is about 96% the same as a 401k. A 401, and it falls under section 401a. So a cash balance plan is a tax deduction, just like a 401k is. So if you're making 300 grand a year and you put 23,000 into your 401k, the government says you didn't make 300. We are taxing you on 277,000, right? The 23k. Cash balance plans is the same thing. You making 300k, you put 50 grand in, the government says you didn't make 300, you made 250. So when your 401k closes, it closes the same way as your cash balance plan would close. You can roll it to an IRA. You can take the money out. So people need to understand what's the end. And how do you pull a string back? That's what we're doing here.
So just to start, this is a qualified plan in the way
Yep,
that people understand this. This is a qualified plan with traditional treatment.
exactly. That's exactly
Okay,
what it
we're
is.
starting there. Okay, so this is what we're now. When we think of a 401k, we can put certain assets into it, but and most people are pretty familiar with that. So I like this as an analogy. But one thing that we can't put into it is life insurance into a 401k,
Yeah,
right?
so there's lots of little differences. I probably could frame it as like, hey, there's 40 differences. There's really the differences between an A and a K, a 401k and a cash balance plan fall into four big categories. I mean, there's so many ways we can diverge, but that's the first one, Hans. You nailed it. The first one is what you can buy. You cannot buy life insurance in a 401k. You can buy life insurance in a cash balance plan. That is the biggest difference. That is the most important difference. I don't think we need to go much deeper in that, except to say people hear that and notice what word neither you nor I used. It's not the only thing you can buy. You can still buy stocks and bonds and hold cash in a cash balance plan. No one's saying you can't do that.
And in
There's
fact, you
just
have
this.
to. We'll get to later, right? Or
You you
you'd
don't
have
have
something
to.
else.
Actually, the majority of our plans don't have stocks or bonds in them or cash. Actually, almost all of our plans have whole life and annuities in them.
Okay, but that's about. But you have to have something else. You can't just have life insurance. So we'll get
Oh
to
yeah, of
that
course.
later.
Yeah, there's limits in that and that. So that's the first difference. You nailed it. The second difference is what gets really interesting is you can put a lot more into a cash balance plan. It's I think they just moved it up from 23,500 to 24,000 or 24,500 this year for the contribution maximum to a 401k. For a cash balance plan, it can be anywhere from that same number to $400,000 of deductions. So massive. It depends on
24.5.
age and income. Yeah, like massive, massive opportunities to say I'm paying myself first before I pay Uncle Sam, and to say, and really where our sweet spot is 45 to 65, 50 to 70, who says, look, I spent 10 years building my business, eating glass, crawling through the mud. I'm trying to find cool military analogies, right? All that stuff. And now my retirement account doesn't match my success. You can catch up. It's a really cool way to catch up. I call it a time machine, right? Trying to get your car to 88 miles per hour, right? So back to the
Yeah.
future analogy. So that's why the second difference, Hans, is you can just put a lot more into it.
Yeah, so the 401k is regressive in the sense that it doesn't scale with you, and for a wealthy client, I mean, even for a non-wealthy client, like 24.5k is, it's not nothing, but for some people it doesn't move the needle enough to even make it worth dealing with it. But since we can scale up, you said how many times maximum? What is
It
the
can be as much as 20x that amount. Yeah, you can get some of
okay?
these can be up
Okay,
to 400 grand if you're, late 60s, ultra high earner, and haven't used any of your other, lifetime
per
limits.
year.
Per year, huge. I mean, you do it for 3 years at 400k. That's a 1.2 million dollar tax deduction.
Wow. So it scales with your income and your age, or a
Yes,
combination of both?
a combo of the both. IRS has specific tables that they put out. I'm so reticent to like cite the table because I could be wrong. As I'm learning, as I'm like talking to more folks about this, there's like people who go out there and edit everything you say and audit it, and you're like, okay, you clearly have too much time on your hands. But I think it's table 2001 of the IRS
Yeah,
tables.
we
But
we ignore comment section and worry about it here. So
but yeah, so that's really cool about it too. Is you can add you can add a lot of capital to it. So the first difference was some other assets open up to you. The second difference was you can put a lot into it. The third difference is actually a con, because I love how you talked earlier, Hans, about like your advisor should be well versed enough in whole life to reject it, which is to say, they should offer you the pros and cons, right? The biggest con to thinking about a pension, I'm going to call cash balance funds pensions, even though it's not an exact comparison. I just think your audience knows pensions really well because of the world you play in. Is that a fair leap to make?
yeah, everyone in the military is. I mean,
That's what I
is
thought. You got
familiar
the
with
10 year and the 20 year,
20
and
year.
yeah, yeah.
You got to get 20
So
here, you get nothing.
this is a private pension. It's 99% the same, right? Legally, probably, if I was in front of the Supreme Court, although you can design a cash balance plan to function exactly like a pension, interestingly enough. The third difference, the drawback is it's at least a 3-year commitment. And IRS says, no, you should do it for 5. So IRS code is a 5-year commitment to this. So one really good year, you got a banger year. And I see this a lot with my real estate agents. They had 2 huge high-end properties listed. And like, I made 8x what I made last year. I want to do a plan, and I say, cool. It's May now. How's year to date goes? Oh, it's my worst 5 months. And I'm like, look, you got to have some kind of predictable. It doesn't need to be completely exact, but you need some predictability in your revenue. So we do this. Our niches are small business owners, but in particular doctors, small lawyer groups, and I think pilots who 1099 or fly, other fly or have moved to flying private after they're out of the military could really benefit from this.
So that's one big. So if I'm tracking along and I'm familiar with a 401k, I get that it scales up with your income, so that's a big positive. I get that I can put life insurance in here, but then when you said a con is that you have to pay for at least 3 years, well, that's a deviation from what we're used to. When I'm thinking 401k, I'm thinking decades down the road. And the why personally I don't like 401ks, and this might be the first qualified plan that we've actually been really excited about on this show. And close to this might be episode 100 or very close to it, but in close to 100 episodes, we've mostly dogged on the idea of qualified plans, not because there's not a place for them, but because they are like the holy grail of the CFP, the first place your money should go. And in reality, to me, it's kind of like an overfill bucket. Like if you've got everything else squared away, again, not financial advice, but personally, I just don't have any interest in tying up capital for decades. So when I think of 401k and qualified plans, it's such a long time frame. I never think about I have to fund this thing for 3 years. I'm like, well, I don't have to fund my 401k, but if I do fund it, I'm planning to fund it for decades. So what is this 3 year and 5 year thing? Because clearly our goal with this is different than just waiting till we're, 59 and a half.
Wow, great question. Lots of thoughts there. The longer you do a pension, the better. Just like, you stay in the military for 10 years versus 20, you have a very different outcome of cash flows, right? So I always want my plans to be in place 5, 7, 10 years. Don't get me wrong. What it means is, great question. Like, I'm trying to think of how to frame this because I've been asked it that way. What it means is, if you have a bad or a tough year and you're a traditional W-2, or even you have a 401k, there's no legal mandate for you to contribute to it that year.
Right.
So, like, perfect example was like, I had a client recently. It's like, we just had a baby. Daycare is killing us. For 6 months, I'm not going to contribute to my 401k. I can pick up an extra $850 or $880 we calculated after taxes, right? Cool. Okay. You cannot do that with your cash balance plan. So when you sign the paperwork to do it, now you can freeze a plan for medical reasons, and COVID saw a lot of plans frozen. So I don't want you thinking it's like, you know, it's like impossible to but you should go into it thinking that like no one goes in the military and saying I'm getting out at year 9 right before my pension gets good. Like no one does that, right? And I don't want anybody being like, I'm doing this for a year and then I'm done, right? And in fact, that's precisely why the IRS has created the guidance that it has, is to prevent somebody with one awesome year super funding a pension and then not doing it, right? Because that's exactly why, to prevent it from becoming that kind of a tax issue that it could be. And that happened a lot in the past. And then really in 2006 with the Pension Protection Act, everyone got clear guidance. And that's why you were seeing the resurgence we're seeing in the cash balance plan space.
Okay. Well, I wish there was a 10-year military pension. It's actually 20 to get the pension. If it was 10,
Well, I
I
thought
would
it was
have actually
half. I
qualified.
thought it was half after 10.
No,
No?
there's now a
Okay.
new program where you can opt into. Well, I don't think now it's past the window where you can choose. I chose. Funny enough, a little sideshow or sidebar here is I was in the period of time where they said the typical system is you have to make 20. It's 20 or nothing. You get 20, you get a pension for the rest of your life. If you do 19 and one day shy of 20 years, you don't get a pension. And Brian was threatened with being kicked out 3 months prior to his 20-year mark, and that's when it was like, that was scary. I got out at about 15 years, but they now have it to where you can opt into. You take, instead of a 50% pension, your pension being 50% of your highest rank pay, you drop down to 40%, but you get a 401k that you can continue on past the military. It's like the blended retirement plan. So you sacrifice the pension to increase getting your to get a 401k match while you're in. So I opted to not do that because I was like, I'm 10, 11 years in, I'm on track. I'm going to make, I'm going to be in for 20 years, no doubt. I've never planned to do anything but fly. And so, like, of course I'm going to make 20 years.
Yeah.
So I opted out of the new system under the certainty that I was going to make the pension. But anyways, obviously that didn't happen. Here we are. Everything's much better now. But yeah, so 20 years to get the pension in the military. So okay, but so there are some ways that theoretically, like, there are situations where you could pause funding it. But for someone who's actually planning on this, your conversations look like based on income, not just having a great year, but based on your average income, we're going to commit to an amount that you are going to fund for a minimum of 3 years, but a
Yeah.
target of 5. What is the difference between there? It's like,
Yeah.
okay, the IRS says they want 5, but they allow you to get out at 3. And let's bring it one more before that. Why are we planning to take this out? Because that's a whole different thing than
Yeah, no, you
401k.
shouldn't. You should. Let's start with that. We would love our clients to do this for as long as they're working, because your love of IBC is that you want your liquidity to scale with you. We view this, because we work with business owners, we want your tax deductions to scale with you. If you're 40 and you can put away 120, great. When you're 45, maybe you can put away 180. So we don't look at it as get in, do the minimum. That's become such an odd dialogue I've had. We look at it as do this for as long as you are working. Build it into your financial planning for your business, right? That's how we view it. But yeah, the 5 and 3 year guidance is 5 years. I don't know how else to say it. Then, but minimum statutory requirement, the minimum requirement is 3. That's how they phrase it in the language.
Okay, so what happens when you take it out after? I just want to package this for someone trying to listen along in their car. You're a business owner. I go to you, or I'm a business owner. I go to you and I say, hey, I want this qualified plan, and I want to do this policy. I want a whole life policy, and I want my premiums to be deductible. So that puts us into this 401a wrapper. We're now in
Yep.
the cash benefit plan wrapper. I'm going to put premium in. I need to commit to being able to do this for at least 3 years
Yep.
of the same amount of premium, and I'm going to get a deduction on that full. That's the main reason I'm like, from where we're at right now, the main reason I'm doing this is because I want 100% deduction on my premiums, right?
Yes, that's exactly right. Okay, so you want to put it in context with the business owner. You are a candidate as a business owner, or if you have a side hustle, if you're a real estate operator, but you have an operating entity like a management company for your real estate, you can deduct this back out. If you have 2 problems, we always want to focus on solving people's problems. The problem is your CPA is saying you need to pay quarterly estimated. That is a great sign that you may be a candidate for this. If you are prepaying your tax liability, that means the second problem is you have a persistent tax liability. Enter the dialogue about potentially adding a cash balance plan. That's exactly the problem we are trying to solve, Hans. So yeah, if you
Okay.
have a persistent tax liability, you're paying quarterly estimated, you're a really good candidate to explore this.
And that's something that a lot of business owners ask is, how can I? This is one of the best possible tax vehicles that I have. Like, of all my assets, this is probably the most tax preferred that I can get as a whole life contract. However, everything that goes in is post tax. So it's like, and that's the conversation I have is until now, it's been, yeah, accept that this is going to be post tax. And then once you put it into this asset, now you get all these amazing tax benefits for as long as it's in the policy. But before then, yeah, I'm sorry, there's just not a way that we can get you a deduction on the premiums. But now there is, for a business owner, for a
Yep.
specific type of client. So let's, before we get into which specific businesses, and I just want to talk a little bit more about what the plan is from entry to exit. Because my takeaway, I first heard about this from you, your interview with Caleb Williams, and my impression was that your goal going in was that I'm going to fund this thing for 3, maybe 5 years and then pull it out. But what happens when I pull out that policy? So now this is actually kind of new to me on the spot, is like the idea that I want to do this for as long as possible. Obviously I understand the value of deductions, but I kind of got that like most people are doing this to try to pull it out after a few years. That's
I
not the
don't think
case.
most people are trying to pull it out after a few years. I just think the
Okay.
IBC community thinks about it that way. There's nothing wrong with that. The
Okay.
pension community that I'm also a part of is like, do this for as long as you can, right? I mean,
Okay.
but yeah, if your goal, and would you pull it out 3 years if you're 67 to 70? Absolutely. Do I recommend keeping it in for as long as you can? Of course. But the mechanics are the same whether you keep it in for 3 years or 30 years. Okay. The mechanics are the same. Okay. Is that where you wanted to go, Hans?
Yeah. So let's go with why would one of our clients who's interested in this, understands IBC and gets the value, understands the mechanics of a whole life policy, why would they want to pull it out? What can they not do while it's in there?
Okay. Let's start with the second question. What can they not do when it's in there? They cannot take a loan against it.
That's it. Yep. That's huge.
Yeah, the wrapper that you talked about, the cash balance plan wrapper that you talked about is you cannot take a loan against it. So why does this appeal to IBC people? And then we should also go over why it doesn't, right? You've set this straw man up for me of you have to be knowledgeable in whole life to reject it. So let's always do the cons. So say, Ro, tell me the cons. Why would someone do it? All life insurance, whether you have a PUA rider on it or not, has a period of time where you have access to less than you've put in, right? There is a liquidity shortfall with all life insurance. The way I've always viewed one of the ways I view life insurance in a qualified plan, there's so many cool attributes, but one of my favorite ways as someone who loves and practices IBC is that I get to get over that illiquidity hurdle, whether it's 3 years, 7 years, 10 years, I get to do it on Uncle Sam's dime. I'm getting a subsidy to overcome the structural headwind of life insurance. I'm getting a tax deduction for someone to build my wealth engine. Fine, all day.
Right. Now, okay. So let's say my policy, IBC client understands what we're looking at in illustration, and this policy quote breaks even at year 5. Pretty common. That might be a little aggressive, maybe a 20-80 policy, 20% base, 80% PUA. Let's say year 5, our total cash value on the illustration surpasses the cost basis in the plan. That's already good in and of itself. But then you're saying if the premiums going into that are also getting us a deduction, we no longer have to come up with, say, to keep it easy, $100,000 a premium. If this is a $100,000 policy, just because that's easy math, and you got to come up with like 124,000 pre-tax to put 100,000 into the policy. You're saying that now if we have to come up with 100 pre-tax, effectively our firepower here is even greater. We're getting the deduction and getting that break even still at year 5. Is that what we're saying?
I heard 4 distinct points there, so let me kind of
Yeah, I
unpack
tend to do
that.
that.
It's all right. No, it's good. They're good. If you're thinking that way, your audience and our case study of whoever's driving the car, unfortunately, listening to this dry ass material is going over it. But I'll start with the easiest to solve. Yeah, if you're going to pay $100,000 of premium, good example because round numbers are easy. You'd have to probably earn 130, 140K and then put the 100K in, right? If you buy it with pre-tax dollars, you're effectively out only 62 or 63,000, depending on the state you live. You're in California, Hans. I mean, you're basically getting this for 50 cents on the dollar, right? Because California taxes are enormous. So yeah, that's the reason to do it. That's the ball game. We could have a 5-hour episode on just that. The other thing I heard was the 80/20 design. Unfortunately, and here's where a lot of people are going to just turn off the podcast, but hear me out. And knowing that, my man Caleb and you love PUA, I've been kicking on a new term. I'm going to create a new term in the IBC world today. This is it. Okay. So listen up.
Sure.
You cannot, well, we'll get to the term. I'm building it up and I hope I deliver. I could just like splat, like parachute doesn't open, right? but you cannot use a PUA rider in a cash balance plan. Period.
Yeah.
End of story. Some TPAs let you. That's very de minimis, but I've heard that that gets audited. So it's just for us at the owner's asset. We will not do it. We just won't do it. We will not use a PUA rider in a cash balance plan. You cannot use it. So unfortunately, the 80/20 design won't work. It has to be 100% based.
And that's okay. And now when a client wants an IBC policy, we go with products that use a PUA rider because that gives us a lot of flexibility in that
Yeah.
if you need to not pay the PUA, you don't have to. Like we love, like that's our bread and butter. We love a policy with a good healthy chunk of PUA. However, that's not the only product that's out there that generates cash value quickly. For instance, so with Lafayette, for instance, a company that we primarily do a lot of our work with, they have the Contender product. That's their whole life 95. That I would say most of our clients that want IBC have that product, myself included, Brian included. However, there are clients where it makes more sense to use a different product, and they have a product that generates cash value on a base only basis very quickly, as quickly almost as your Contender. And that's because the premium payment schedule is a little compressed. You get cash value early, but blanket over all of that with you can get the same metrics with a base only policy with a lot of these companies. The reason we don't do that for you, if you're a client, you say, well, why wouldn't I do that? Is because why would we do that when for the same for the same amount of total annual premium output and the same performance, you have kind of the flexibility of the lever to pull where if you want to not pay the PUA, if things get tight, you could trim off 80% of your premium schedule at, if you desire to. Whereas with this policy, you're committing to the full base. And of course, with the cash balance plan, we're doing that anyways. We're committing to the full amount anyways for 3+ years. So there are products. Don't worry. Don't be dismayed that you can't use a PUA rider. You can still get very aggressive cash value early with products, right?
You can. It's not going to be the same because the PUA is really effective. But here's coming back to that term I've been dying to drop because I've been I went for long walks this week thinking about walking with you. I view, okay, this is a owner's asset ism here, right? But I view getting the tax deduction as a synthetic PUA. Right, that's the phrase. It's synthetic. I know. It was hit me like a ton of break, and it's like because who cares if it's break even in year 3, 5, 7, 10? And here's the argument. Here's the other argument. Argument's such a strong word. I'm relatively. I don't want to get into the whole design debates because every design is different. Everybody's different. But here's how when we put in place our cash balance plan, here's how I'm going to design it. Okay, so you're getting it straight from, I want to say the horse's mouth, but then I'm the horse, which is a stupid analogy, but you know what I'm saying. At some point, PUAs drop off.
Right.
Okay, so let's use your exact example of an 80-20 design, okay, 20% base, 80% PUA. And you keep the PUA on for 10 years, okay? Let's say that. So in year 11, what are you on the hook for to the insurance company? If an 80-20 design, 80% PUA, year 11, PUA drops, how much do you owe the life insurance company?
The 20% of that.
20 grand, exactly. If I had a client that had that, my exact advice would be, and assuming they fit all the myriad of checkboxes for a cash balance plan, be like, okay, we know we have 80 grand of free cash flow coming in year 11. Pull this out in year 11, keep it in the plan for 11 years. We'll size it at 80 grand. We'll size it at 100 grand. The cash flow you were used to putting into your other policy, now the PUA's dropped, that same exact cash flow can go into another policy. It's just the deduction is a synthetic PUA, which is such an interesting way to spin it. And then when it comes out in year 11, it's not going to change your cash flow per se, but you've gotten the first 9 years of building on someone else's dime all day long. I would do that. So people get so caught up in this high early cash value, high early cash value. The PUA trap, as it were, is I hope, it may not be the case, no one knows in life, I hope my passive cash flow, my cash flow grows every year ad infinitum, right? Well, when my PUAs drop, I like the idea of an all-base policy in my portfolio of policies, in my system of policies. I like one that's all-base, so I always have a place to put capital. Anyone who worships so much at PUA and hyper cash value efficiency may not be a good fit for what we do. I still think they are, but I just don't. I have a sense that they're going to be like, oh, this thing is break even closer to year 7. We can get a break even a little sooner. Sure, we shorten the payment period, but then you're not able to put in money in year 11 when this thing is hyper efficient, year 20 when it's hyper efficient. All-base policies have a really important role to play in a wealth planning perspective. Maybe not purely IBC, but in a planning perspective, absolutely an all-base policy that you just did on Uncle Sam's dime via synthetic PUA, dude, it's a force multiplier. Look at the military terminology.
I like the synthetic PUA, and it kind of, I'm sure you could sit down and calculate what the crossover point is, where when you add in a deduction, how much of that compensates for, you know what I mean? You could find a point where X amount of premium at a typical IBC structure is equal to X amount of base only 401a cash balance plan. There's a point where you don't need to pay as much into this policy to get the same effect when you factor in the deduction. So that kind of brings down or brings up the value to the IBC client, where it's like, okay, yeah, maybe I'm giving up some liquidity. And now here's a big thing for the IBC client. The reason we want that cash value is because you want to borrow against it, right? Cash value doesn't, I mean, it's valuable to have, but just like cash, it's for being deployed. Just like, gold is valuable to have, but it doesn't do anything for you sitting in your safe until you use it to acquire goods or services or assets or liabilities that it's all about conversion and the actual velocity of money here. And so cash value is great to have. And the reason why clients get so dialed in on how quickly can I get this efficiency is clearly because they're thinking about having this as available as a store of value that they can leverage and deploy, right, via policy loan. But remember, you can't take a policy loan while it's in this wrapper. And so this, if you're incorporating this as an IBC client, you should probably, do you think of it as separate buckets? Like,
Yeah.
let's say me, I have my IBC policies that I use, and I'm investing out of, using them for investments, emergency fund, et cetera. Is categorically, is this just a whole separate thing? Because while it's in here, I'm not using a policy loan. Like it's a totally separate part of
Yeah,
my
it's
strategy,
future
right?
planning. Yeah, it is part of your strategy, but it's future planning. It's saying, oh, I've already started my next policy. Good IBC practitioners, good IBC thinkers, and I'm going to keep trying to bring it back to planning because I love IBC, but it's a small component of why I love whole life, right? But good IBC practitioners are always going to be thinking how quickly, how soon can I start my next policy? What I'm trying to say is view this as your next policy, but you're just getting a massive, again, synthetic PUA. You're getting a deduction to start it because it will come out at some point. So I view it that way. I view it
Yeah.
as this is my next IBC policy. It may be a little slower one for compared to one that's max PUA, but I'm not sure it's slower because you're getting this huge tax deduction. And even if it is slower, the tax deduction is worth something today for an asset you already want or you need, don't yet know you need, and will open up back to our very first dialogue about how my wealthy clients thought. This will open up massive optionality. Optionality has immeasurable value. I make all of my decisions, and my co-founder, Mark, who runs the company with me, we sit and talk once a week and we say, okay, which decision opens up the most optionality? If you have a policy in your plan and something happens to you, God forbid, you add the optionality of protection. Millions will just transfer to your family. That in and of itself is probably worth it, right? Especially with your audience that tends to be a little higher risk in terms of their day jobs, right? I mean,
Yeah.
that alone is worth it, that optionality. When it comes out, the optionality to keep it in your state and do banking. When it comes out of the plan, the optionality to move it out of your estate for protection. If you're a physician, who we love serving physicians, we spend a lot of time with physicians, it's creditor protection. Whether you're in a homestead state or not, it's creditor protection. You have the optionality to annuitize the cash value if you just want cash flow. If you don't have heirs, optionality is why you do this. People get so stuck on that PUA dialogue, and I'm like, that's 1/5 of it, 1/6 of it, right? You got credit protection, you got estate planning, you can annuitize it, you have all these wonderful things you can do with the asset. Am I willing to get a tax deduction for optionality? 7 days a week, twice on Sunday, brother.
Yeah, absolutely. All right, I got a couple questions. I'm going to start real quick. Just going back to the PUA. Incidental benefits provision, is that the verbiage? Is that the right verbiage for why we can't have this PUA? What is that, and does it matter? I mean, again, I know like you've made a compelling case for why we shouldn't really be worrying about PUA in this, but given that it's like top of mind for most of our audience, what is the reason that we can't have the PUA?
Yeah, and I'm not going to go into code. I'm just going to English it up, okay? Uh,
Yeah.
and I have to use a little bit of it, but there's provisions in IRS and Department of Labor statutes that say the death benefit cannot exceed 100 times the monthly future pension benefit, the 100x rule. And so since PUAs, you know, grow the cash value and ultimately the death benefit, it's likely to trigger that. So there's a limit on how much you can buy. The second reason is anything that enhances the growth of the policy. A policy can't be more than a certain percentage of the plan. A policy can't be worth more than about 40% of a plan. So anything that triggers either of those two limits how fast or how much insurance you could put in. And so those would trigger those provisions. What those provisions are and how they're calculated, let the actuaries figure that out. But those are the calculations, though. So the present value of the death benefit cannot exceed 100 times the monthly benefit.
Okay.
And so that's what it is, and that's why there's rules around it. And this goes back to, I think you did a podcast maybe a couple days ago where you were talking about MEC rules, right?
Yeah. Yeah.
Pretty recently. I watched it to prep, right? This is the retirement system's way of saying like you can't put too much in here. It's the same
Right.
concept. Conceptually, you can't overstuff to trigger a MEC. You can't overstuff to trigger these provisions in the tax code. It's a good bridge. It's a good parallel to understand the two, right?
Okay. Okay. So we can't use a PUA rider, but we can achieve the same outcome effectively And really, the intention of this is not for PUA. So if you're stuck on that, don't let that be a barrier for you. Another question on the creditor protection. So does the creditor protection just mirror what you have with life insurance? Like I know in California, your cash value is protected only up to like $13,500, I think, from creditors, which is preposterous, given that most states it's 100%, right? Every day there's reminders of why it's a terrible decision to live in California. They pop up all the time. But
But then you go outside and you're like, oh, this is beautiful, and there's like produce falling on me, like from wherever I
yeah,
go. Yeah.
exactly. Yeah.
Creditor protection is a
But
great comment. Yeah. You just made an argument, a comment, or I use that word too much. You just made a comment as to why keeping the money in the plan is for longer is better. Let's use California as an example. It's 13.5. I don't know. I'm not familiar with California's specific statute, but who cares what it is? Let's say it's 50% of the value of the policy. When the policy is inside the plan, it gets the full protections of ERISA, Employment Retirement Income Security Act. So 100% of it is creditor protected when it's in the plan, just like your IRA, just like your qualified assets are protected. So we get another huge benefit to keeping this and adding this to your portfolio, especially for our physician clients, and in California. So you get even better creditor protection on the asset when it's behind that or above that blood-brain barrier in that qualified system. When it comes out of the plan and it's in your name, it's subject to those rules, each state specific rules. But
okay,
there's an enhancement to
so,
it, interestingly enough, by
so
framing it the way
enhanced.
you did.
Okay, that's awesome. That's awesome because I always cringe when people talk. So that is one of the huge benefits is creditor protection. And I'm like, yeah, just not here. Um,
Yeah.
okay, cool. And that's why we're moving to New Hampshire in the next 2 years. That's one of many reasons.
We'll
But
see. You loved California when we spoke, so I think you're digging it. So let's go. I want to spend a minute back on the whole, PUA is the greatest thing in the world. It is with after-tax policies. Let's go back to that your example of a 2080 and the PUA drops and this policy comes out and it's picking up that cash flow. I said optionality is the gold standard. Optionality is how we at our business make all of our decisions. Here's the real reason I love that. The other reason I love it. I love it because you need a place to put cash flow. You need a place to put capital. Where I see retirement plans, Phil, and we started this company, Mark and I started this company to solve the retirement crisis for small business owners. There is a retirement crisis in America. The data is unbelievably scary and bad.
yeah,
And we can't solve it nationally. We absolutely can use the tax code to solve it for physicians, for small business owners, right? For lawyers. And so what I love about it is if I have a policy that is level premium forever because it's all base, I got a deduction to get it. I got my synthetic PUA. When you get Social Security and you take RMDs from other assets, if you have other qualified assets, you want them to go there first into the policy. Then you want to pull them out. I view at least having one all-base policy forever as part of your retirement plan so you can self-escrow your Social Security. So you can self-escrow your property taxes. One of the biggest challenges, two houses for sale up the street and they're both the oldest two people on my street. They're getting taxed out of their house. It's heartbreaking. If you do even if you have a small policy, 12 grand a year in a pension, who cares, right? You need a place to self-escrow your taxes. Imagine recapturing the tax on your Social Security. Social Security is taxed. People don't realize that. It's taxed as W-2 income. So if you
yeah,
get your Social Security payment and you put into a
crazy.
policy that's been seasoned for 30 years, you're going to 4 or 5x that. Take a loan to pay your taxes on that. I think everyone should have a policy, at least one that's all based forever. My worldview, strong statement. Listen up in your car. Get a tax deduction to build your all based policy. That's why I started this company. I can link planning to asset protection to deductions to retirement with this strategy.
Yeah, it really is. It's top to bottom, or I guess bottom to top. Uh, but when you said that, so at 59 and a half, like, is that when you can start taking policy loans? Because you mentioned borrowing against it. Like, how do we use this as an escrow if we can't take policy loans against it?
Once you take it out, I meant once you take it out, because at some point you'll stop
Oh,
working. So when you close the plan, it comes out either way, right? If you
okay.
buy life insurance in it, you have other choices when you close the plan. You can surrender it for cash value and then invest it in the S&P, or whatever. But all of our clients on the way in, we're coaching them to take it out, right? And so that's what I mean. But everyone should have one all-based policy as part of their system of policies. Is a strong view I have for those reasons I just
Yeah.
mentioned. Why not get a deduction to do it? is how I view it.
Okay, so this is attached to your bit. Like if Brian and I started this today, and Remnant Finance dissolves, like at some point, like in 5 years or 20 years. Well, when your entity dissolves or you retire from it, you are no longer
Mm-hmm.
uh, able to put money in, and at that point, you have to take everything out of the plan. Is that right?
Have to take yes. Then the first half is when the entity's done, the plan is done on the first half of that question. The second half of that question is have to take it out. No, let's go back to what we discussed. You don't have to take money out of your 401k when you leave an employer. You can roll it to an
Mm,
IRA.
okay.
You can roll this to another entity. However, life insurance can't be rolled to most other entities. So that's where the cool distribution strategy comes into play. I'm going to
Okay.
grab my, I'm
So now
standing up, so I'm
you,
super excited, but I'm going to sit back down here. But
yeah,
yeah, yeah. So you would literally make that decision of, okay, I want to take it out. Now I've listened to enough of your guys' stuff that you want sovereignty. Sovereignty is a word I hear a lot on your podcast when I'm prepping to meet you, and it's taking it out enhances your sovereignty. So anytime you can get some of your money out of the RMD system, you should. I'm not saying the RMD system's bad, but when you can say, I'm willing to pay a little bit of tax now for an asset that's tax free forever, that's a good trade. That's always a good trade. That's a bold statement, but it's always a good trade.
yeah. Okay. I have one more question on the PUA rider, and I know you can slap me. Say stop worrying about the PUA rider, but I have one
You're
more
going to be
question.
like, can you put a teeny one on there so that I can stuff it when it comes
Yeah.
out, is what you're going to ask
Yes.
me.
Yes.
My understanding is no. I have been asked that before, and I will make calls to like, I'm pretty technical in this, and I think most people who sell cash balance plans know just enough, and I try to be a subject matter expert that speaks English. Um, I will put in some calls to like ERISA attorneys, and because it's my understanding that currently, if you want, and my understanding is no.
Okay. Well, if your recommendation is to like just stop focusing on this, don't do it. If our clients that have businesses want to do this, just take Rose's advice. Don't try to like mold this into our focus on IBC. Like it has an enormous suite of value. Let it be its own tool. Stop trying to put a PUA right on there. I'll
Yeah,
be done with my
don't take
PUA
your
question.
don't take your Honda Accord to the racetrack, right? Your Honda Accord's your steady, it's your grocery getter. You use it every day. I have a Honda and I'm obsessed, right? So I'm not going to turn it into a race car. It's like that guy who like tricks out his Civic and rocks the hard hand. Like that's what you're trying to do here, right? I don't want to do that with this policy. So because even if you could, let's run the counterfactual. Let's say we find a team and get an opinion letter from a lawyer, because I personally still wouldn't do it, and here's why. Anything that's going to take a safe, well-defined tax strategy and move it to a risky one is not worth it. At the end of the day, cash balance plan's fundamental value proposition is a huge tax deduction. There's 3 points. It's a tax deduction, a way to get life insurance with wholesale pricing, not retail pricing, right? And finally, so yeah, the tax play, the asset that you get from it, and then the last value proposition of a cash balance plan is that it's a tool you can use to manage your wealth on the back end. And so, why would I want to bastardize that to turn it into something else? It's the juice
Right.
ain't worth the squeeze. The juice ain't worth the squeeze. It's you know what I see coming, Hans. I am terrified. It's a strong word, but I'm real worried with the recent legislation to allow alternative investments in 401ks.
Yeah. It's going to be brutal.
And that's what people are trying to do to the cash balance plan system. The cash balance plan is really well defined. It's been around for a long. It started as Section 412I in the 1920s. So there's 100+ years of precedent to this. And when people try to play games with it, is where you get the bad press. And that, there's a ton of bad press on this stuff 30, 40 years ago. So I'm not going to be part of as a champion of this industry. I'm not going to try to find loopholes. I just don't think ethically it's a standard that we set for ourselves at the owner's asset. And yeah, so no, I wouldn't do it if it was allowed to try to
Okay.
put like a sleeper, sleeper
Yeah.
PUA rider in there. It's just well, not worth
All right. That's good. If you wouldn't do it, we're not going to do it. All right.
it.
Questions. You've mentioned wholesale versus retail, and one of our episodes that I would like to do is going back and forth on from start to finish how we have this conversation with the client, what kind of like process wise. But what do you mean by wholesale versus retail?
Yeah, it was what I was mentioning earlier, and I think you used the $124,000 example. But if someone's going to pay $100K of premium, they have to earn 140 grand. And you're in California, so 150 grand. You have to make $150,000 to pay 100,000 of premium because taxes, right?
Right.
That's all I'm saying. So that's the retail pricing is earn 150 to pay
I see.
100K.
Okay.
Wholesale pricing is I'm going to give you a 45, 47% tax deduction in California, 50% tax deduction in California to get this. So you're paying 50 grand. Would you rather pay $50,000 for a $100,000 asset, or would you want to earn 140 for a $100,000 asset?
My first thought is really hate California, but yeah, okay, definitely.
But you see what I'm saying? That's how I like to frame
Right.
it to get people to
Okay.
understand and people say, oh, because the biggest objection we get, and it's worth noting, is the rate of growth is low. Well, it's low for a reason and by design. One, because there's just buckets and buckets and buckets of guarantees in this stuff, but it's also low because the IRS tells you you cannot earn a ton of money in a cash balance plan.
Yeah.
And so that's that's why it's perfect for this, and that's how I view it.
I definitely want to get to that. I want to get to the the caps or like the target, the corridor. Like we're gonna dive into that. But before
We're
that,
going to be here a while, aren't we, Hans? You want to get into
yeah,
everything. Let's go.
honestly, I mean, we've done episodes that are close to an hour and a half before. This is definitely gonna be the longest one if this is a single episode, because I just have so much more to talk through.
Fire away. Fire away.
All right, let's talk about when you talk about distribution, whether that's 3 years in or 30 years in. When we remove the whole life from the wrapper of the 401a, one, is there a difference between doing that before 59 and a half and after? And two, mechanically, what does that look like? Are we doing policy service requests with the company? Are we just filing a paper with the IRS, a form with them? How do we get it out mechanically from being under this wrapper? And then what are the implications of that?
Okay, so I heard the first question was pre and post 59 and a half. I'm just writing them down. And then the mechanics slash IRS. Okay, great. Let's start with the 59 and a half one. I think that's a little more straightforward. My understanding is yes, you get hit with that little bit of extra, that 10% early withdrawal if you pull it out before 59 and a half.
Okay.
So
On what? 10%
on
on what?
a little bit less than the cash value. Basically, it's not exactly. So there's like a lawyer listening, but a good guide, a good rule of thumb, a good framework is the cost to pull it out is the cash value at that time.
Okay.
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 So
Well,
if
the
you pull it out,
cost or
yeah, the tax, the value of it that's going to be taxed.
okay, yeah, gotcha.
Okay, so I'm losing you. So let's start the whole dialogue over. Let's always, whenever we're confused, let's compare and contrast it to something we already know. Cool.
Cool.
If you pull $1 million out of your IRA at age 50, before 59, at age 50, the IRS is going to send you a bill for how much?
So $100,000 on the
$1 million in IRA. You're pulling $1 million out, and you're 50 years old.
So 10% on the penalty, and then income tax on it. So in that case, like if you're a 30% earner, you get a tax for $400,000.
Exactly.
Right?
Well said. Perfect. So I hope the listeners can follow that. Okay. The IRS says when you pull money out of a qualified account, it's not treated as long-term capital gains. It's not treated as short-term capital gains. It's treated as if you earned it and went to a job.
Yeah.
Right. So the same rules apply
to
to
income tax that you didn't pay on the way in.
Yes, exactly. Because they're smart. They want to tax you on the harvest, not the seeds, right? They're like, okay, we'll let you grow a compound, and then our tax asset coming to us, your tax liability is going to compound, right? They're smart about that, right? So that's exactly right. So life insurance works the same way. When you pull it out, if the cash value is $1 million, you would get a tax bill for 30 plus the 10 because you're before 59 and a half. But why is this better and different? This is the most important dialogue we've had so far. We've had some good ones: synthetic PUAs, proper planning, self-escrowing in retirement. This is huge and this is hard. Let's lock in here. A lot of custodians, when you pull an S&Ps out, they're going to withhold 10, 20, 30%. So you're only going to get 700 to compound off of, right? They're pre-funding your tax bill. When you pull life insurance out, you get the full $1 million of cash value. A custodian legally cannot touch it. So do you want to compound on $1 million and write a check to the IRS for the 400, or do you want to compound on 700 and write a check for the remaining 100 because they kept 300? Let's say they withheld 30%. I would always rather compound on the million, collateralize it, take the loan. Because remember, it's coming out. We can take the loan. It's come out of the qualified system. The loan feature has turned back on.
Right. So
So,
in this example, we're not surrendering the policy. We're just removing it out. We're keeping it as life insurance. It's now a whole life that we're paying.
yep.
And okay. And now we have $1 million of cash value, and we are going to take a $300,000 policy loan to pay it. So we basically created the corpus out of which the tax is paid. Golly.
So good. Isn't this amazing? That's another source of arbitrage. You're basically saying, fine, tax me, but you're not changing my cash flow. I'm going to use the policy itself to pay back Uncle Sam. You gave me a deduction for this. I'm going to use the assets that you let me deduct to pay you back. Whoa, everyone should be leaning forward. And I know other advisors listen to my stuff in particular and yours. And that is unbelievable because it's still a taxable event. The IRS isn't stupid and no one should ever be looking for tax loopholes. No. Tax opportunities, tax strategy, tax planning all day, every day. That's what we do. But this is the opportunity to say, fine, but you're giving me optionality. I'm going to use that word a ton today because it's how I think. You're giving me optionality to either pay it with money I have or pay it from the asset itself, which cannot be done when you pull stocks out. It's either going to be withheld or you're going to liquidate those to pay Uncle Sam. It is a taxable transaction, but it is a cash flow neutral event. Whoa, full stop, drop the mic.
And that gets back into the conversations we have about the power of a policy loan. Now we're out of the 401A wrapper. We're back into IBC effectively, where if you're selling, if you're selling $300,000 worth of stock to pay the tax bill on your million, you now have $700,000 worth of stock that's going to grow. In this case, we take the policy and then we have $1 million of stocks that's growing, also earning us dividends, which we can use to pay the interest on the policy loan if we choose to. Now we're back in the world of IBC, and it's awesome.
Not only that, you didn't finish the analysis properly. Ready? There's one last cool. This is the cherry, the whipped cream, the denouement, the whatever you want to put here, right? The 700,000. Let's say you kept it in the S&Ps because you love them. And look, I love stocks. I hate this false dichotomy of stocks or life insurance. We're going to cut a whole episode on that because I hate that. I am using strong language because I am fired up about that. And I will probably always have more wealth in equities than I do in life insurance. And I have definitions and reasons why, but that's a whole nother topic deep in my gray matter. The 700,000 of S&Ps that we just pulled out, is it taxable?
Yeah.
Of course. It's out of the qualified system. Are the dividends taxable?
Yeah.
Of course. The million of corpus are dividends and capital gains. And if you sell some, it's capital gains. If you hold it, fine, but you're still paying tax on the dividends. The $1 million of life insurance, is that taxable? No, it's whole life.
No.
Are the dividends taxable? No, it's return of capital. So you're not
but the moving it out of the 401A.
That one-time tax, both are taxable. Whether you move S&Ps or life insurance, that taxable event. But what you're doing
from
now, from that point on, you've created a whole nother set of tax tailwinds because an asset that comes out of the qualified system that's not whole life is taxable.
Right.
Even if you just say, I'm going to hold cash in a money market. Well, the money market's taxable. Sorry, you are getting a 1099 INT for that. You are getting one. It is a taxable event. You are not getting a 1099 for your life insurance. You buy S&Ps, it's taxable. The dividends are taxable. You need to sell some to live, taxable. You need to sell some of your life insurance to live. You do it via a loan, that's not taxable. Your brain is going in overdrive. I can see your face. And this is why I'm tired of the whole, if it doesn't have a POA, I'm not buying a dialogue, because what you're doing is creating entire tax-free ecosystems here.
And that's what's hard. And I wanted to ask about, we'll get to your process later, but one thing I do want to ask is, as far as the visualization tool, it's hard to think through. It's hard, like the problem with, wealthy people are constantly thinking about tax optimization, but it's really hard to think of it in the big picture and be like, if I make this decision today, maybe and not specific to this, just in general, like I could spend more money on this decision today, and my net at the end of the year, the bill that I owe the IRS will be lower by more than I could make if I put it in over here, right? And like today, it just feels like an expense. It's like I'm actually cutting a check today and sending dollars somewhere to do something, and I know that down the road, it's hard to think through that and visualize it. So like, yeah, you're going to get some great tax advantage. You're going to get like your tax bill as a business owner will only be $50,000 this year instead of $150,000 next April. It's like that's hard to make expensive, quote, expensive decisions on today. Do you have a tool where you can kind of see this as a whole, or is it kind of like you just got to understand and like, and I think that's a muscle that you train. I mean, I would not say like I'm not wealthy to the, like my high net worth friends and clients, like, but I imagine when you spend your life thinking about taxes and it's like everything, you expand how far you look into the future and how much you think about your tax bill. And coming from the W-2 military world where you never see the taxes to begin with, they're already out of sight, out of mind. They're just automatically deducted. Such a insidious setup, I think. It's just where like you never think about taxes. You don't make decisions based on taxes because all you're doing is hoping you get a refund, for a couple $1,000s at the end of the year, like as a military officer. It's such a bad, it's such a poor man's way of thinking about it when in the wealth world, you're obsessed with taxes. How do you visualize that? Or do you really, is that not a challenge because your clients are typically like already in that mindset as wealthy business owners?
A lot there. Okay. Yeah, growth is hard. Learning is hard. Learning takes time. Learning to harvest the tax system to your advantage is a skill. It is a learnable skill. It is a skill that compounds. So anyone who wants to learn, call us, call you. Let's talk about it. Let's start putting masterminds together. So that's the first answer to that. Because again, we talked a lot about what separates the wealthy from that. They're not necessarily smarter. They're behaviors. I mentioned that, and their structures, behaviors and structures and optionality. Behaviors, structures, optionality, right? And so this is how they think about it. So you said the tools. Yes. For our process, when someone wants to get to know the cash balance plans, we work them through it. We have an intake form, and then we will go and reverse inquiry to a couple different third-party administrators for the plan, just like your 401k has an administrator, right? And we generate a proposal. And what we do for every single prospect, whether you become a client or not, is we cut a private video. I live behind a camera. I cut a private video where I go over their proposal and say, this is your contribution amount. This is how much you can deduct. If your tax bill was X, it'll now be Y. You will spend this in cash flow to get this much back. We do it for every single prospect, and we load it into a private channel on YouTube so no one else can access it, so your information is not out there. That's been our best tool. I think a good CPA, and we've had a lot of good CPAs work with us, and a couple of CPAs are like, I don't know it, so I'm not going to learn it. A good
Yeah.
CPA actually says, hey, you're paying 60,000 a year of quarterly estimated. If you put in place a plan, it's going to zero. And they'll say, to get 60,000 of deductions, you need to put 90 here. And the client goes, well, I don't have 90, I have 60. Well, great. Let's put 50 to a plan and drop your quarterly estimated to $2,000. Same cash flows, just where they're going. So it's never an all or nothing proposition. So those are the two techniques we use. We take a proposal and I cut a private video, and I always bring in the CPA. It's an opportunity to educate them if they're open and curious and make it tailored specific to the client.
Okay.
And
Cool.
it's your other question about behaviors. Are the wealthy? Yes, the wealthy think almost entirely on taxes is the most dominant conversation I have. And they look at stocks as just another asset class. They're not sitting around adjudicating Chevron versus Exxon and who has more exposure to the Strait of Hormuz or Sakhalin Island off of Russia, right? They're like, good, it's an asset class. I want X amount of it. Can you get it to me? Can you get it from me cheaper? Yes or no? Can you get it to me via deduction? Yes or no? Great. Next asset class. Same series of questions I probably answered 3 times a day for 4 years as a chief investment officer.
Yeah. And that's I'm excited for let's add that to our list of future episodes. Like
Oh
that
God!
life
All right, I'm
insurance
on the
first.
show.
Yeah, you're permanent guest host now for a while until Iran is wrapped up.
Right, until Brian comes back.
But the idea of like it's not stocks versus life insurance. It's both. How do you coordinate it? 'Cause we hammer the idea, like you said, you were just talking about, of like the first place you go is like, what's the best investment? What's the best stock to pick? Like that mentality. You just got to load up your qualified plans for future value. Like we hammer that idea. And I think that I always try to caveat like, hey guys, I'm not saying we don't invest. I'm not saying we don't do equities. I'm just saying, let's think about order of operations. Let's put the foundation in place. Let's not just try to build a high rise on a foundation of sand. So I think it might come across that we just hate investment and all you should do is insurance, which is absolutely not the case. So I love the idea of talking through that further, but getting back to some of the mechanics of this 401a.
Yeah.
I have an existing whole life IBC system, right? If my policies have a PUA rider, one, can you take an existing policy, transfer it into a 401a, and two, or 1A, if that has a PUA rider because it's an IBC policy, that would disqualify it if you can even do that? Or do you always start with a new policy into a 401a?
My understanding is you cannot move an existing policy in. Moreover, I would never do that. I would
Okay.
never, ever, ever do that. You have been building a policy with after-tax dollars. Why would you put it back into the pre-tax system?
That's true. Yeah, of course.
Because then you're going to pay a tax on it again to get it out, right? This is for the deduction. We said, what are the value prop of a cash balance plan? It's for
Okay.
the deduction first and foremost, right? For tax planning. For two, it's for whole life at wholesale pricing, and three, it's for downstream optionality. Those are the three value props of a cash balance plan. So even if you were allowed, I wouldn't let a client do it ethically because they've already built and funded and started a policy with after-tax dollars. Then you're going to pay taxes again to get it out. So even if it was allowed, initial reaction here is I wouldn't do it, right? That's like, why would you take after-tax money and put it back into the pre-tax system?
Okay. Yeah,
This is that
that's obvious.
the remnant versus the system talk you guys have had in the past on some of your episodes, right? I don't love having too much money in qualified plans, but if I can get assets in qualified plans, one, it helps me feel secure for the future, but two, if it's whole life, I'll do it all day, every day. That's why I love cash balance plans. Notice how I haven't told people to go max out the 401k. If they want to, go ahead. There's value there. I'm not saying it's a bad thing. I'm just saying if you can get a tax-free asset with pre-tax dollars that stays tax-free on the back end, you've changed your future trajectory.
Okay. As soon as you started answering that, I was like, oh yeah, of course, that doesn't make sense. So that was not even a well thought through question. So we're not going to take a policy that we might have written for you and put it into this plan. If you're going
But
to
what's
work with Rohit
cool,
to
what
start,
this does do, but I think there's a cooler vein to that question. There is, you can take part of your convertible term and convert it. So if somebody's already underwritten, yeah. Oh, light bulb. Okay, I just like you had a moment. Fire away.
no, that okay, that keep going
That's
with that
super
because we
cool,
have a
right?
lot of
So if as an advisor you're doing a good job saying you have some whole life, you want to do some future planning, let's have some convertible term. Maybe you never convert it, but you need the bridge because you're the income earner. You need the protection. You'll have other liquidity. Maybe we don't plan, but good planning has convertible term. Period. End of story. Whether you decide whether
yeah.
you hate whole life and you're one of those people who says this is crap, Dave Ramsey's right, which he's not. Dave Ramsey's right. Um, I need it as a bridge. Fine, fine. And all of a sudden you say, I'm starting to like whole life or I like the CB idea. Yeah, we can break off a part of your convertible term and assign it to that 401a wrapper and do that, especially if your health has changed or you did it 6, 7 years ago when you were 20, 30 pounds lighter, like kind of the way it always goes. Yeah, you can do that.
That's huge because
That's
we
huge.
incorporate. Yeah, we want someone to one. Let's figure out. Let's ballpark your human life value. Let's make a plan like how much of that we want to cover. Ideally, as much as we can. But if someone's worth $7 million, they may not want to insure all of that. But let's ideally, my preference for a client, for every client, especially a father, let's calculate that number. Then we're going to shift our focus to whole life without concern with how much death benefit that gets us. Not because it's not important, but because we can bridge the gap with convertible term. So we focus on premium, funding your IBC system. Now we have that number. Let's say that gets us 25% of the way there. We bridge the gap, the remaining 75 with convertible term. We lock in that rating. We check the protection box now while keeping our foot in the door to prohibit or preclude becoming uninsurable, or if we're maxed out, like we can't get
Yeah.
any more insurance anyway. So like we have a lot of clients with big amounts of convertible terms. So that's awesome to know. That's a great.
Yeah, and if those
That's a
clients have started a side hustle, have active 1099, or they've incorporated, or they're active real estate investor, now you've done the future planning with the convertible term. Now we can overlay a tax deduction for it. And that's my earlier point. We've created this runway because this all-based policy will come out, and now they can self-escrow real estate taxes. They can recapture taxes on their Social Security. So it's this whole idea of retirement. For me, I love cash balance plans. Like I said, the retirement planning aspects of it and whole life. The intersection of those two is just so wonderful to me.
Shit, man. The wheels are falling off the car. They're spinning so fast. Um, okay. So let's talk about the allocation. So you mentioned it once before, and we said at the beginning, you can't just have life insurance in a 401a. So we're starting with a client who's just hearing about this for the first time. He might be has IBC, maybe he doesn't. He goes to you, wants to start this. So one, what do we need to have in there? And you mentioned 40% before, 40% maximum in life insurance. What do we need to put in there? And then we'll just start there. What do we need to do with this?
Sure. And the first comment about he comes to us, our organization, the Owner's Asset, we partner with a lot of other advisors actually, because advisors who have big books of business and are really good at relationship management may want a technical expert like us. And so I imagine, Hans, we're going to be partnering like that for the clients who say, hey, that was a good episode, let's explore it. So we partner a lot. So it'll never be just to me, is what I'm saying. It'll be to the group or the entity, the team, the organization, because we are tactical experts in this, right? What does it look like? There's a lot of choice in the design of a cash balance plan. You can be 100% stocks. You can be 100% bonds. You can be, as the name suggests, 100% cash. Okay. You can be 100% annuities. You can maximum be 40% insurance. So
Okay.
those are your ranges. You can be, so which means any other combination therein is allowed, with insurance being capped at 40. So it can be 40% insurance, 60% stocks, 40% insurance, 60% bonds. It could be 40% insurance, 20 bonds, 20 cash, 20 equities, as sums to 100, duh. But like that's it, you have all the latitude that you want. The real dialogue is there are not small, not medium, but gigantic, enormous, apocalyptic trade-offs to these design elements. And this is the difference between being someone who just sells cash balance funds and talks about them versus someone who lives, eats, breathes, sleeps them like I do. There are huge trade-offs in design elements. But I hope I answered your question about those are what
Yeah.
they are. 100% of any asset class except for insurance. Insurance is capped at 40.
Okay. Yeah. I am not going to even attempt to, like, if you're listening and you want to have this conversation, I'm going to refer you over to Ro, and then I'm going to ask your permission to sit in on the call to learn as much as I can. I'm not touching this thing for you. This is like, you're going to be working with the owner's asset. If this is something you want to set up, I want to learn as much as I can about this. Partially because I think it'd be awesome for Brian and I to set up for our business. I want to explore this on a personal side. So a lot of these questions are just like me thinking
Yep.
about how do we approach this. But yeah, to be clear, you're not going to be getting your cash balance plan through Remnant Finance. You're going to be going through the owner's asset, working with Ro. Now,
Well,
why do
maybe.
you
So
know
just so you
why?
know, Hans, just so you know, when we partner with other advisors, we have that advisor as the lead agent. We're not here to take relationships or sit in on them. We're just here to help you guys. But yeah, we will do the compliance. We'll do it all for you, for the advisor and for the client. They're super hands off, other than, oh, you want insurance, pay in a cup. It's much more detailed than that. But you'll
Yeah.
stay front and center with your clients, Hans. I don't want you to think for a second. It's going to be through the owner's asset, but you're front and center, boss man. Okay, you're asking, do I know why? And then, sorry, I cut you off. Do I know why there's these
Yeah.
limits, or
Yeah. So
why
I'll
are the
say whatever's
trade-offs?
best for the client, we're going to get the best outcome for you. But why 40% life? Why is that one asset restricted? I have a suspicion, but I'm
What's
curious
your
if you can
suspicion?
actually. My suspicion is the same reason as there is a mech in place. It's because the asset is so powerful
Yeah,
that Congress needed to be lobbied in order to throttle it. Because if it wasn't throttled, if we could fund life insurance without restriction, it would be the only product. I'm not. That's the bold claim. It's not. It would be every single American would have it, because there would be no impetus for financial services companies to try to market against it, because it would be so powerful. I mean, it is so powerful, it has to be throttled. I'm guessing
yeah,
that
it's
would be the
exactly
same.
it. If you could put your whole 401a in it, you'd run into human life value calc issues. You would be too big of a tax opportunity. Yeah, they want to. You can't be worth more dead than alive. That's kind of the general part of it. Is the biggest issue, and they know it's self-interest on the IRS part. They know that it's tax-free on the back end, so they need to get their cut somehow. They need to get their cut somehow, so they limit it. But that's exactly it. It's exactly right. And I've mentioned this before, but I view the tax code as a puzzle.
Uh,
And if you're a business owner, you've opened up the opportunity to be the architect of your own destiny. If you're a W-2, it's not a puzzle, it's a straight line. That's it. Here's point A, point B. You get your standard deductions. Do you do this? Do you do that? That's it. If you're a business owner, man, the world is your oyster in terms of tax planning. My view of the world is tax planning is an asset class into itself. So there's stocks, there's bonds, there's whole life, there's annuities, there's tax planning. I started this firm with Mark because that is such a powerful view that I have, is that the minute I started owning my own business, I was studying the taxes just as much as I was studying product, and it's changed my life dramatically. I have tailwinds
Say
that
that
I
again.
never had before.
Tax planning is an asset unto itself.
Yeah, tax
That's
planning, I believe, is an asset class.
that that tracks with what I was saying about my friends who spend their days worrying about
Yeah,
like that is like that's such a great way to say it. That's so
I know. And
succinct.
you're like a helicopter pod, so like we're just dropping missiles or bombs, whatever the right analogy is, because we got synthetic PUAs, we got this stuff happening. But I just think about this stuff very differently because anytime I can solve a problem for a client so that they can focus on building their business, my role is to make you better at building your business. My view is your highest ROI activity as a business owner is running and managing your business. Outsource this to somebody else. And we check in with our clients all the time. We have an awesome annual review process that we've put in place at our firm, and it's super cool. Custom slide decks that we do for every client. We have proprietary calculators and all this really neat stuff. And so I just want my business owners to thrive and lower their tax bill, and that's it. That's why I'm doing this, because I'm a small business owner. I know the bludgeoning pain that it is every day of waking up and eating glass. It's just miserable. It's miserable.
Yeah, kind of living that right now. Okay, tax
So yeah, you're
planning
saying
isn't.
the life insurance is 40%. Yeah. So that's my view of it, is that taxes are a roadmap, and that taxes are used by the government to create social change. And so what they're trying to do by allowing this tax deduction is say, look, you're a business owner. You eschewed, you stayed away from the security of having your health care paid by somebody else. You have to pay for your own 401k. Now we're going to give you these other deductions to make sure you end up on the same footing or further ahead. And that's why I think this stuff exists to begin with.
Okay. So what is the restrictions on the returns? I know there's a corridor there. Let's just say we go, let's start with what someone might be thinking. Okay, cool. I'm going to max out my life insurance because that's the most powerful element of this from a tax perspective. But then if I've got it in this umbrella, I might as well max out my returns. So let me do 60% equities, 40% life insurance. What's the problem there? And what are we throttled by here?
Yeah, so the IRS's view is we're giving you this huge deduction, potentially $400,000 a year, 500,000 at some agent income levels and structures, right? And they're saying if we're giving you this huge deduction, you can't go take excess risk. You can't get a huge rate of return. You wouldn't put a pension. Let's go back to this pension example. You wouldn't put a pension 100% in the Magnificent Seven, right? Nvidia and right? You would get
Yeah.
in trouble for that. It's the same view. So the IRS says around 5%. It's called a fixed crediting rate, and you could pick it when you design the plan between 3 and 6% typically, but you're not allowed to peg it to something ultra high volatility. You're literally not allowed to do it in the plan documents. So the IRS says we're giving you this huge deduction in exchange for which you can't take too much risk. If you take a ton of risk, that's fine. One of two things is going to happen. Your deductions in the out years will go down, meaning we'll let you put less into this, right? Your deduction goes down, you'll put less into it. Some clients are like, fine, I'd rather get 400 grand in year one and then less in the out years. Okay, but your deduction's gone down. And the whole, remember, the value prop for cash balance is tax deduction, whole life at wholesale pricing, and downstream optionality. When you overfund a plan, you lose all three of those. May not be a trade-off to other people. The second reason, if a plan has too much money in it, I'm actually working with a prospect right now, went 82% stocks and 18% bonds for about 9 years, caught this whole bull market. Did this deep analysis, took me two and a half months. I'm working on this case. I looked at him and said, your plan's overfunded. You cannot retire. If you retire today, your plan is so overfunded. I think it's sections, I don't know, I don't want to cite the wrong section, 67, 708, something like that, where he would get hit with a 50% excise tax on all the money because the IRS says 50.
What?
Yeah, they look at it as a tax dodge. You're saying you overstuffed, you took too much risk in your pension. And so literally, if you have and the wirehouses are starting to get in trouble for putting only AUM assets in this stuff. There's been a couple of news articles in the last year about this, but if you overstuff it, fine. You just either lose the deduction or the plan becomes, in the worst case scenario, the plan becomes overvalued. So obviously the guy wasn't ready to try right away anyway. So there's a technique out there called pension risk transfer, where you turn an equities portfolio into a hybrid of whole life and annuities, our preferred design. That's actually what all of our plans but one are, right? So those are the two major challenges, of taking too much risk. You either lose the deduction and or you hit with an excise tax or have to push out your retirement. None of those are palatable to me. The IRS
Right.
wants you hugging 5%. That's just the rule.
Okay.
Okay, the flip side of that coin is underfunding. Let's say you buy stocks and there's a bear market. Okay, now you have to make the plan as a pension. You have to make the pension whole. If the plan was supposed to be worth 200 and the market goes down to 30, right? That means it's worth 140, 30% of 200, it's worth 140. You have some time. It doesn't have to be done every single year, but over a rolling 2 to 3 year period, you have to true that up to the right number, right? An underfunded pension is a liability. We saw this in the 80s and 90s, why corporate America moved away from pensions, became too expensive, right? And the real reason we saw the pension crisis in America, people don't seem to realize this. I'm way off topic, right? But the reason we saw the pension crisis in America was really a symptom of the 1968 to 1981 bear market. There were 30-year declines in that lost decade, right? So why would you put your pension at risk to be overfunded and be told you can't retire, have to pay taxes or lose your deduction, or underfunded where you have to true it up and maybe lose your tax deduction or not get a deduction on the extra money or be underfunded for retirement? So we recommend using safe, secure stuff, whole life and annuities. That's what we design as our plans. I don't want that risk for my clients. That is not a dialogue I want to have with them. So we don't do it. We just don't do it.
That sounds kind of analogous to why, and we've had some clients that are very intent want an IUL, for instance, and we just won't do it.
Yeah, I've never written an IUL.
Yeah, it sounds almost like a variable universal life when you're talking about trying to tack your insurance and your stocks within. It's like a trying to do a 401a where you're stuffing it with stocks is kind of like why you would want a variable universal life, because you're like, I want this upside appreciation, but then the downside. We would never do that. But philosophically, my view on taxes is like your patriotic duty to reduce your taxes as much as possible. Like the best thing you can do for America is starve this government. I don't buy the view of like, well, like we're all contributing, like we're building bridges and roads. Like I don't take that view at all. I think that it's almost like a robber's coming into your house. It's your duty to hide your valuables as much as you can. And the limiting factor there is like, don't let your family get killed over keeping your ounce of gold. Like at a certain point, give them the gold before they kill you. I don't want to go to jail for tax evasion, right? So I'm going to do what I need to do, but it's on me as an American to reduce my tax liability as much as possible. But philosophically, that's how I think about it, and that's why we're moving to New Hampshire. But
from California to New Hampshire, I get it. But my view of taxes is the same. Reduce them legally and ethically. I'm not going to do anything that's not allowed, right? And this is code, like I said, it's been around forever. Back to the what's the solution then? Look, if you're going to put greed over planning and say, I want as much upside in my cash balance plan, great. You're not a right fit for us. See you later. Yeah. Fine. Go do it with somebody else. No big deal. Don't want you as a client anyways. But if you say, okay, I kind of get these trade-offs. Look, you can pair a 401k with a 401a. You're allowed to do them simultaneously, Hans. And in fact, you can pair your 401k with your 401a and your profit share plan. So in the K in the profit share, make sure I didn't drop the wrong finger. Yeah, in your K and your profit share, buy all your equities. Do that. Right. Take your risk. I am a risk taker. I've started my own business, right? Right? But why play chicken with the IRS in the 401a system? Take risks. And by the way, I know you're a risk taker if you have a 401a because you're a business. You're an entrepreneur. Right. So why double down on your risk? Why play chicken with the IRS? Why lose a deduction? Why have it overfunded? Why have it underfunded? It just juice ain't worth the squeeze, right? There's 5 ways you can get doinked in one way this works out. Why not just focus on the one way this can work out?
Yeah, and we've got more to talk about on this. So for another episode, that idea of, like Tom Wall's book, Permission to Spend, and a lot of Wade Fowles' work, a lot of like the idea that having your whole life is a bond alternative. It's a replacement to, like, if you can supplement 3 to 5 years worth of retirement income with a whole life policy so that you don't have to subject yourself to sequence of return risk when the market's down, that concept, it kind of translates here in a sense like, take your 401a and view it as the safe steady down the middle play. And then that allows you to not have to worry about, like, I think the dumbest thing you can do, and it's funny, I'm studying for the Series 65 right now, and it just blows my mind, like the level of detail in the CLU textbook and the course there versus the Series 65. It's like they're still talking about 100 minus your age is how much you should have
Yeah.
in stocks, and like 60/40 portfolio. I'm like, how does anyone still buy this? That's such a preposterous plan to me, when clearly, if you are not marketed, like propaganda against life insurance, it's so obvious that whole life should be your bond alternative. In my mind, it's an it's undeniable at this point that you should replace your bond allocation with whole life, in my opinion. But this idea of like, whole life gives you permission to spend down your assets. Whole life gives you a buffer against the volatility of the market. It allows you to take more, to be more heavy in equities in your retirement plan, because you can supplement income with this whole life policy. That same thing translates here. Take your 401a down the middle. That allows you to go 100% stocks in your 401k. And you made a great point with Caleb. The years that you're chopping off by going, like, right when you really start hockey sticking upward, is when the financial advisor tells you to take half of that off the table and move it into bonds for a safe. It's like, that is so preposterous to me
Yeah.
that
It's just starting to get good. So you asked me earlier in the episode, from a Wall Street guy to whole life. That was probably your dialogue just now is, and I mentioned on the Caleb episode too, is like that was probably the biggest reason I fell in love with whole life. And I still love markets and stocks, and right. But I can look at a client now and say, and probably do it from the bond perspective. I cannot look at a client who has any allocations to bonds and say, I this will be higher next year, right? Bonds have gone down. Q1 of this year, 2026, Q1 of this year, stocks and bonds both went down, right?
yeah,
The definition of a bear market for dorks like me is cross asset correlation convergence, which means everything behaves the same. In 2008, real estate, stocks, bonds, and commodities all went down, right? As a deflationary spiral, right? And whole life is correlated to a contract. It's correlated to nothing else. There's not even a correct mathematical comparison for it, because
right.
it's correlated to a contract. And so for me, I can be like, wait, do you want something that always goes up? And then pair that with the risky thing, and now all of a sudden everything sings, everything blossoms. Because the wealthiest clients that I had and have all have staying power. And whole life represents to me staying power. From your parlance or words you just use, it helps you stay on the equity curve longer. That's what I was talking about with Caleb. Anything that helps the rest of my things work is why I want the thing that may be less sexy. How do I view building wealth? This is a pure roism here, right? This is I view building wealth as building or connecting an atomized chain of call options, a series of ventures, whether it's my own business, an allocation to the S&P, the venture capital, a piece of real estate. It's this atomized chain of call options. And in the middle sits whole life, because it allows all the rest of those to trigger, right? That's the way you see bombs go off. And it's like, well, if one doesn't, but the others do, I'm still really good. But if nothing happens, it's a dead fuse, so to speak. I still have this core asset in the middle that's going to do what I need it to do. To me, it completes the meal. And so that's why I fell in love with it, for all the reasons, enhanced IRR from leverage. But yeah, and then I fell in love with cash balance plans because I'm going to get it at a discount. Sign me up. Let me go start a company around
Absolutely.
that. Well, that's what I did.
Do you have a visual for that? What you were just describing about, like, kind of a sequential step of call options that basically ratchet you up without going down. Like, is there a visual for that, or is that
Other
just
than
kind
the
of how
video
you
we
think
just
of it?
recorded, not yet. But I post a lot on LinkedIn, and I have a post called like "You can't fall off the floor," right? Because if my whole life is going up as my wealth goes up, hopefully, then I'm raising how far I can fall. And then if the wealth goes down, I don't fall as low as the wealth on paper, right? I fall to the whole life level. And Mark and I put out an episode for our first one ever. Actually, it's not on our channel yet, but it will be. We believe there's a huge distinction between statement wealth and contractual wealth. And I know a lot of insurance guys use this parlance, so it's not new, right? We've bought into that. And this idea that statement wealth is something that could happen, and contractual wealth is something that will happen. And I love the interplay of those words, because if your plan is based on a series of can happenings, you don't have a plan. You have just the
Right.
atomized chain of call options around a coreless, vacuous, right, middle there. Whereas if you anchor it now you have time for that fuse to catch and for everything else to sort of to boom, to blossom, to do what it needs to do.
And that kind of sounds like the way I often talk about. There are places in my strategy where the words if and may and could and hope are allowed. And there are areas where they absolutely are not allowed. I don't
Mm-hmm.
want any ifs. I don't want any if the market continues its average of 10% a year, then X. Hopefully we get this to happen. Like all of those things, that's where I take risk. That's where it's like, I don't know that, that my option strategy, crypto, S&P 500, like we don't know. Those are all we have is past data. All we can do is look in the rearview mirror, and then try to make predictions based on what we see behind us and then what we expect to come, right? But that's where those if statements live. I don't want any if statements in my protection and savings. It's like, if when I die, especially if I die early, that is the last place in the world where there's allowed to be any uncertainty, is that my wife and my daughter's life doesn't have to change financially if I'm not here to earn. Like that is before anything else. That is all that matters. If that's not buttoned up, if there's ifs and there's holes and there's all kinds of uncertainties baked into, well, these things have to happen in order for my wife and my daughter's lives to
Mm-hmm.
not be materially changed if I'm not here to earn income. If there's any leaks in that dam, nothing else I do matters one goddamn. Like it is all on that. That has to be buttoned up. And then we can talk about this other stuff. And that's such a powerful, like,
Yeah,
get your
because yeah,
yeah.
you mentioned order of operations, and I have a video on LinkedIn called PEMDAS, right? Please excuse my dear Aunt Sally, and that's exactly how I view. I mean, we're so aligned on this, and what's funny is the vein that started this, the question that started this is, why wouldn't you go 100% equities in your cash balance? Go ahead, not for us. And this goes back to, I said, okay, if you're choosing greed over taxes, I still view that as a false dichotomy. I still view that as a false choice. So if I have a client who says, I want the tax deduction and I want the equities, I'm going to say, you're not for me, but hear me out. For the 5 years you're in the plan, for the 7 years you're in the plan, still do annuities and whole life. And here's why. You get the protection, right? And if you don't want to keep the whole life, fine. But what if you die? To your point, there's no hole. Your comment made me think of this. There's still a hole in your plan if you don't have insurance. If you get to put 300 grand a year, let's say it's a high income earning physician and they get to put 300 grand a year in for 7 years, that's $2.1 million. When you close the plan, you can surrender the life if you want. You can surrender the annuity. You can whatever. Now you have 2.1 million to roll to an IRA. Go trade options. Go do whatever the heck you want. If you were greedy, it's still not worth the IRS audit or overfunding or excise tax squeeze. But my point is, if you are only worship at the altar of IRR and you're greedy, your design element should still be an audit-proof design element where you're creating optionality, that word I love, on the back end to have a multi-million-dollar IRA and go buy your Magnificent Seven, go all in on the trip queues, go do whatever you want. If that's your choice, what I'm saying is to create a large retirement corpus, don't take on audit risk to do it.
Yeah.
I get it. I actually get it. Some people just want that. Great. I still won't work with you because now you're subjecting me and my organization and that TPA to risks that I wouldn't recommend they take or I take on for what? A couple hundred grand extra on a $2 million corpus in the event that you're assuming it's not going to be a bear market. Your 5500 form 5500 is going to be filed and all that stuff. It's like, what's the point? It's so funny how people try to solve a long-term problem with a short-term solution. And I
Yeah.
view anyone designing plans that way as doing that.
Yeah. So keep these things separate. Like I just love that idea. Like if we think about the stadium filled with water analogy, where you take one single drop on day one and the next day you do two drops, and every day you double the amount of drops you put into the stadium. At what point is the stadium halfway full of water? The day before it's full of water, right? If you double
Yeah,
the amount every day,
yeah.
or the I give you a penny today, 2 pennies tomorrow, 4 pennies, 8 pennies, 16 pennies. How much do you have at the end of the month? You have millions of dollars at the end of the month, right? The largest, it's like the day before the stadium is filled with water is halfway full. If we think about that equity curve, why are we truncating that? So on your 401k, why would you ever go anything but 100% stocks if you have this side buttoned up? So let's talk about, we use an annuity because annuity gives us that guarantee. So there are no questions. So in this area where here's all the ifs and the what ifs and the hopefullys and the coulds and the maybes,
Mm-hmm.
and here's the certainty, and no matter what's on that side, we can put our 401a with life insurance and annuities because no matter what happens, that return is going to be exactly corridored to that 5% target, right? Because we can do that with
Exactly.
whole life and annuities.
You're designing it on the way in to be compliant. You're designing it on the way in to meet the corridor. You're designing it on the way in to be self-fulfilling. You're designing it on the way in to have no problems on the back end. And then what you choose to do, the optionality you create on the back end, that's entirely up to you. What you want to do. Liquidate it, pull the
Now
insurance
that's
out, surrender it, do whatever you want.
so that client that's coming to you that has an annuity already, I know we're not moving life insurance that exists into this. Can we move annuities or equities into this, or is it also you're starting a new annuity, like you're a blank slate, starting a 401a,
Oh, so
everything
that
goes
client didn't
into
have
it?
annuities. They were 82% stocks, like I said. But interestingly enough, it's a good question because this goes back to your question from, I don't know, maybe 7 hours ago when we started this podcast. But like, but if you take the money out before age 59 and a half and you don't want to pay the penalty, you can replace it. Yeah, you can swap assets. The pension has to be made whole. So yeah, if you pull out because you say I really want the life insurance, and I have shares of Johnson and Johnson over here or S&Ps or something that is tax inefficient, you can put it back in. So there's a way to get around that 10% penalty if you make the plan whole, right? You can do a redemption to make the plan whole. So to answer your question is yeah, you can put something else back into the plan if you want. Absolutely. Now it's typically got to be something, plain vanilla stocks, bonds, cash, equities. I don't recommend putting insurance back in. I wouldn't put something, and most administrative companies won't allow you to put something in there that's hard to value. That because they have to reconcile the plan each year. So you can't put like a piece of illiquid real estate back in, into it. But
Okay.
you can put something that is marketable, easy to value, transparent in the plan, and avoid that penalty because you're just saying, no, I'm just doing a swap here. I'm changing my asset allocation in the plan. I'm taking the insurance out, right? I've hit my
So if you were
synthetic
going to take
PUA limit.
synthetic PUA, yeah. So if you were going to take the insurance out, and now you're just going to move it to your name, now I own it. I mean, I still owned it, but it's no longer. It's a personal policy. It's not in this pension plan anymore. I'm leaving that remainder 60% annuity now is just 100%, and I'm still compliant.
Well, if
Or
you've
have to.
replaced the 40% assets back in, it's compliant. If you, yeah. So you have to make the plan whole if you take something out of it. So when you
Okay. And so
close a plan is the other dialogue. If you close the plan altogether and you pull the insurance out, there's no need to make the plan whole. Yeah.
going back to our 100,000 example, if that's the number that I'm going to put into this, if someone comes to you and says, "Hey, I can put 100K a year into my cash benefit plan," let's put 40 into a life insurance premium and 60 into an annuity each year. And
Mm-hmm.
then 3 years later, I decide I want to use this policy for infinite banking. I put 40K into a policy. 3 years later, let's say I've got, just for simple math, like I've broken even, which is quick, but let's just say I'm at 120K of cash value. I pull that out. I pay the taxes with a policy loan. And now there's 60K a year into the annuity. Now I have to put 100K a year because the metric when you're talking about percent full is the target annual funding of 100 grand. Like that's the
Yeah,
benchmark
that's the
moving
TPA is going
forward.
to say this plan's underfunded. Your plan is not compliant. You need to add assets. That's why if someone comes to me and say I'm pulling this out in 3 years, I'm going to say keep it in for 5, keep it in for 7. Let this policy grow alongside you as your glide path down the road. But if someone does want to do that, yes, the money can come out, the insurance can come out. They could take a loan to put some of the money back in, but the plan should be made whole. We do not want an underfunded pension.
So we're not using like a single pay annuity for this. We're using, in
You know,
this
there's
example, a 60K year annuity for a period of time, or how does it work with annuities
Yeah,
since they can be
great
single?
question. Yeah, so carriers out there have annuities designed for pensions where the year 2 contribution doesn't start a new 7-year surrender or 5-year surrender or whatever. So it's just a chassis designed for pensions where
Okay.
yeah.
Okay. And so really it behooves you to just start everything from scratch. Start with owner's asset, and you guys have the annuities that work for this. Like I don't really need to understand why the IRS says 40% life insurance, and we can speculate, but I don't really need to understand why. I just need to know
Yeah.
that's the limit. I don't really need to understand inside and out how this annuity is structured, just that it is structured for this. If I want to put 100K into this pension, I can do that, and you guys help get all squared away. Okay.
Yeah, and I want
Um.
to swim in this annuity part for a second because why do I
Yeah.
love adding annuities to plans? Because annuities is a dirty word, and I was super anti-annuity until I read Wade Fowle's work, like you had mentioned, and the whole idea of guaranteed income. And they don't apply actually more often. Insurance applies more applicably than annuities, is my worldview. But why do I like them in plans? Well, we already went over part of the reason. They make it compliant. They make it simple. But here's the third reason. Again, I design everything in my life, in my business, and for my clients and their pensions for maximum optionality. If you have an annuity in there, okay, and let's say you're over age 59 and a half, all right, you've pulled the insurance out and you have an annuity, you can flip it from accumulation to income. You can tell the annuity provider, now start spinning off the income. You've just created the income to fund the policy. There's a little tax friction when it comes out of the qualified system, but
Yeah.
this is my favorite part. And it's so funny because people hear the word annuity and they stop listening. And I'm trying to say, no, no, no. I'm trying to build a closed loop system, right? And I think in terms of systems, IBC is a process. Here's what's so my unique spin on this is the famous, I think it's James Clear quote, where he's like, if you don't achieve your goals, you fall to the level of your systems. Well, if you have built a cash balance fund the right way and there's 60% in annuities, you can just flip on the income feature and you've created the income needed to keep that policy alive.
Yeah. That's
Whoa.
awesome.
It's self-completing. So now you got a place
Yeah.
for your Social Security to go to recapture your taxes. You got a place for your RMDs to go to recapture your taxes. You got a place to self-escrow your real estate in retirement. Now you got a place for your annuity, which is usually fixed, to now grow. You put 20 grand of annuity income into a policy that's 20-year seasoned. How much is 20 grand turning into in a 20-year seasoned policy? You look at more illustrations than I do, Hans.
I just did a 20 grand. My example that I used that I walked through on this, the episode that dropped today, actually, Friday, the May 1st. I used an illustration walkthrough in discussing the mech, and that 20K a year that he was getting on this example. I mean, it was a 2080 policy, so we're back in IBC world, but I mean, 20 years in, you're putting in 20K, you might be getting 60K in cash value. Like
Would you
it's
like an annuity
enormous.
that pays you 20K after taxes? There is some tax friction if it's coming out of the qualified system, but you're still getting a guaranteed check forever to go into a guaranteed policy that 200, right? 3X is 200%. That's that's the ball game.
Yeah,
You got
this is
it. That's the
crazy.
ball game. You got to give up saying I'm greedy. I need all my assets in the equities world, and that's why I think pairing the K with the A is the move. But I love cash balance plans so much because it's putting that permanent floor, like I talked about. It's the middle of my atomized chain of call options, and that's what real planning is. I'm a retirement strategist, a retirement planner first and foremost. We focus on the small business owner, and we do it with CB plans because it creates 10, 12, 20 points of egress on the back end.
Wow.
Your head is just spinning at
Incredible.
this point.
This is incredible. I mean, you have to get off of the idea of every single dollar's role is to be maximized for the highest possible ROR. We have to understand that dollars have different places in the strategy. Some of them are not just to like go and whore myself out for the largest return. I have to have dollars that are tax optimized, that are savings optimized, protection optimized. Like every dollar has its job title, and when we can delineate that way, we don't have to approach this insurance planning conversation with how do I get the most cash value as quickly as possible. Like these have a specific role. So that's one thing we need to do is stop just hyper focusing on ROR for every single dollar. And the second thing is you need to disregard the quote experts. Like for our audience, like you don't trust the CDC, right? Their recommendations are going to leave you in the hospital perpetually. Like you don't trust the CDC, you don't trust the FDA with your family's food, right? Like in the same way, like Dave Ramsey is the CDC of the financial world. If you're taking this, if this is how you're thinking through this, like you need to shed your ideas about obviously whole life, because I think if you're still listening 100 episodes later, you have done that, but also annuities. You know, annuities are done by insurance companies, and therefore they're demonized by AUM just as heavily. And a lot of it, like there are bad annuities out there. There's bad everything, but when you understand the power of it, and especially here, it's almost like critical. Like annuities is your best case for this other 60% if you're putting this strategy in place. So you need to kind of shed a lot of the prior assumptions that come into this and
Yeah.
understand like how these work in sync.
And I would state that even if, yeah, bold statement can be, especially if you worship solely at the altar of IRR, whole life is important in retirement because there will be a bear market at some point in your retirement. Borrow from the asset, go buy the S&Ps. When your money comes to a new high water mark, so let's assume you have 2 million of cash value and 10 million of S&Ps, okay? Well, the S&P drops to 8. You should take a loan from the whole life, buy the 8, okay? Buy it at 8. It's going to get to 12 faster than the same time it would have taken you to get to 10. Same trajectory because we just added 2 million of corpus, right? The move from 8 to 10, the 2 million was 25%. The move from 10 to 12 is a little less, but give me a little bit of latitude here. Then you take that 2 million from the now 12 corpus of S&Ps, pay back the loan, and you're back to where you were faster, right? You can put a permanent wealth floor underneath this if you have whole life in there. And so my ideal retirement for Roe is I'm going to annuitize enough of my portfolio to pay my premiums, and I pay premiums forever. And then all the rest is going into the risk bucket. All the rest is going to the risk bucket. But that is exactly how. The exact numbers are TBD, right? Because the S&Ps is a can world, not a will world. But I 100% intend to annuitize the exact dollar amount needed to pay my premiums forever. So if I just live off of annuities going into whole life and I live off of whole life, great. And then every other dollar is go for it. Stay on the equity risk curve forever, get my 8th compounding, get my 9th compounding. But that is exactly my retirement plan. So here it is on video, but that's exactly what I'm doing. And I'm going to get
That's
those
amazing.
annuities in whole life via tax deductions, by the way.
And the cool thing, all of this, everything you just said is, I will do this and this will happen. That is so powerful. Like now you can go feel free to take your risk elsewhere. Like we talk about the castle analogy. You build your savings castle, you build your insurance moat around it, and then you go take risks outside the castle and risks that aren't going to put, that aren't going to expose your castle to risk. Like you take the fight out there, not here. And you can say everything you just said about your plan is like it will happen because you have annuities with certainty. You have life insurance with certainty. It's just so cool. Man,
Yeah,
it's so
and the
cool.
word we didn't use enough today because why did I fall in love with this side of the business? And I'm going to be on. I was running money, and we're not right now, and I imagine getting back into that world again to combine the two. I just want to step back and focus on just insurance for a couple of years to get sharper. Learning is earning. Mark, my CEO, has built a culture of it's just two of us now, but hopefully it won't be one day. We are first and foremost a learning organism. That is how we actually define our business. We are an adaptive learning organism, and so we'll be adding stuff to our practice or going back to stuff I have 2 decades of experience with. And so what I find super interesting, about this is that word behavior. And so if you have those things in place, it allows you to have the right behaviors to be a successful investor. Okay, what does that mean? Why is Buffett so storied? Munger, Berkowitz, Tilson Tung, Einhorn in the early 2000s. Just go down the list of the greatest investors of all time. They didn't panic when things got low. They were wired differently. Instead of feeling fear, they had this sinewy, metallic adrenaline taste in their mouth to go buy things. I don't believe most people are wired that way. And when you have life insurance or annuities, you can be wired that way. The data is so cool here. The data tells us that one, people with annuities actually live longer, which is my favorite annuity stat of all time. Forget the guaranteed income. There's
Good.
this cool study out of, I'm blanking. I don't know if it was Harvard or MIT. But people with annuities have a longer lifespan on average because they have that like peace of mind, right? And if you have
Wow.
money coming in, you have high ground money is what I call whole life. You use the castle analogy, I call it high ground money. If you have high ground money, it makes you more likely to go on the attack, not the defensive, not be a forced seller. Imagine retire. You call sequence of risk is what it's called, and I love that. You retire into a bear market. Yeah, now you're greeting people at Walmart. You retire into bear market with annuities or whole life. You're a net buyer, and your Monte Carlo just went from 93 to 100. Because you cannot Monte Carlo your way to a successful retirement. You need to do a Monte Carlo. I'm like trying to find middle ground to tell you, are you on track? But you cannot Monte Carlo your way to a successful retirement.
Yeah. You, I guess you can't put a price tag on peace of mind, but really like in the longevity studies, like I guess there might be a price tag there, it's so powerful. Like my dad was with I'll say Department of Defense, but he State Department for 30 years or so, and he retired with a pension. So he's not going to be at Walmart no matter what happens. My father-in-law was with the Massachusetts State Police for 30 years, has a pension. not going to be going to Walmart. I'm not going to get a pension now because of everything that transpired with the military. And outside of the military, most people aren't going to get pensions, but you can create your own pension. And I think like you're going to have a pension that you create here. And that's so cool. Cause I honestly, I listened to your interview with Caleb on the conservative side 10 times through
Jesus.
at 1.5 speed, which for me is slow. I typically try to do I like to consume as much as I can at 2.5 speed. So I slowed it down and took so many notes. I have a page of notes here. Um, Probably 10 times that I listened through it. And because I need to build a pension. But even going into this conversation, I was thinking that my goal in starting this was I fund this for 3 years and then I pull it out. Because I didn't really
No.
pick that up because I think probably because my mind is wired to IBC and Caleb is an IBC guy in the whole life. And so it's like the everything I talk about when I'm thinking about the power of this asset, a lot of it, not everything, but a lot of it comes back to how do I use it now? And so if we're doing this for the IBC perspective, it might be look a little different where you can pull it out at 3 years in, but it's definitely changing my focus even going into like you guys have an ebook, I guess, about this,
Yeah,
right?
we do. And
Product.
folks, and we can add it to the show notes. But if you go to our website, The Owner's Asset, under resources, we wrote a 24-page book. We update it each year with guide to business owners, how it helps you. CPAs, we actually tell CPAs if it's a Schedule C, meaning a 1099, it's on, you reconcile a plan on line 17. If it's we literally walk a CPA through exactly how to reconcile a plan on their taxes. So yeah, because we're educators first. That's what we do. Do a plan with us, do it with somebody else. But I want to swim in this pension world, and then we probably should wrap up. Otherwise, we're just going to basically be doing
Yes.
this all night. But that's exactly the word that is so interesting. Is I'm going to just actually, yeah, this is probably, and you can see like no cards in it. This remains one of my favorite retirement planning books of all time, right? And I
With
referenced it
options.
on the Caleb
Yeah.
podcast, and I literally have 2 copies of it because I hand it out. And yeah, I stamp every book because I hand out books like people do candy on Halloween. Like my clients get books probably once a month with handwritten notes of what they like, how it applies to them. If you
Shit,
have
man,
a
you
pension,
set a high bar for business.
we do really neat stuff, but we're
What
super
you
small,
send?
right? So
You send out a book every month?
I read almost a book a week, but I send a client, at least one client, a book, not every client a book, right?
Okay.
Um, um, but
Golly.
this idea of having a pension is so important because it is the behavioral governor over letting the rest of your stuff work. A 401A can be designed, and I hate the term I'm about to use, but because I hear it pitched this way and I cringe. I've been in the room where a Series 7 broker has pitched it as a 401k on steroids. All you're doing is tripling down on sequence of risk. You're risking an audit. You're creating all these problems. You're just doubling down on the fundamental problem retirees face. My
Right.
official advice to folks, recommendation or thought experiment rather, is design your 401a as your pension so that everything else can stay risky. That's why I love the dialogue you had that your father and your uncle have pensions, that the police officer in Massachusetts. They're never going to have to worry about that. And that's why I brought this book, the Fifth Option book, out. Is he creates this analogy of if you're marooned on an island and you had one bucket of water, how much would you drink each day? You don't know. You don't know how often it rains. Maybe it doesn't rain. Maybe it's a desert. Like that is what an all sequence portfolio gives you. Add something 20, 30% to something with no sequence of returns. Epic. Actually, and we have to end here because we're both smoked, but
Yeah.
Ernst and Young, huge third party, non-registered life insurance company, right? Put out a huge study, and I can't remember, it was 2018 or they update in 2020 had it, but we send this
Yeah.
to clients all the time. It's this huge 18-piece about how showing that on every level from in 10% increments from 10 to 50%, adding either an annuity or life insurance creates more net wealth than not. This is a neutral third party study. This isn't like a mutual insurance company putting out buy our stuff or Wall Street saying don't buy their stuff, right? This is an auditor. They are an audit firm doing this. So super cool. Let's make sure that and our playbook are in the show notes, I think, to help folks
Yes.
to digest this stuff.
Yeah. That I have that bookmark, that study, and it's so powerful. And it's like I don't understand how someone hasn't sued Dave Ramsey for how many people have been just totally thrown off of the wealth trajectory. Like get to zero, that's great. Get out of debt, that's great. If you need to eat right and beans and cut up your credit card, if you need that advice, then you need that advice. But like for how many people that could be setting themselves up so much better, like how is in light of the Ernst and Young study, like how is this marketing campaign against whole life allowed to continue? I feel like if it was the other side, like people are so trigger happy for lawsuits when it's financial advice. Um, if it was the other way around, I feel like there would be so many lawsuits against this level of I would say malpractice as a fiduciary responsibility. But I guess if you're just condescending enough and you just do a radio show, you just get a free pass, I guess, on terrible advice. But
I'm not
that's like,
wading into the whole feud here, the Dave Ramsey stuff. Just suffice it to say, I
yeah,
it really comes down to personal taste. Um, if guarantees don't matter and you're so affluent that it doesn't, I actually get it. I get it, right?
yeah,
If you're on the bubble, it'll change from a will to a could. Or, I mean, from a could to a will. And if you're underfunded for retirement, yeah, that's just a whole different can of worms. So I actually think there's a strata, and
yeah,
so I'm not here to throw stones at anyone in any industry or any field. All I can say is I struggle to find any wealth strata where whole life doesn't have a role. Ultra affluent, it is liquidity for estate planning. The middle tier, it's the staying power, and on the low end, it's the income replacement, right? It's you don't want your spouse, significant other to have to dramatically change their life should something happen to you. So that's my worldview, and it may or may not resonate with other people, but that's sort of for me as a planner and a mutual fund guy and a CIO. Adding this makes everything else better, is why I fell in love with it. Is it the greatest thing in the world by itself? Maybe. Yes, no. But does it make everything else sing and hum and dance? Oh, yeah.
yeah. There's so much more to it. I love it. I respect that you don't throw stones. We load up hellfires and we just send it. I think. All right. So this is by far the longest episode. I don't know if this is going to be um, two episodes or not, but we've got here's moving forward. Here's a few more episodes I would like to do. I'd like to do a small business owner case study. We have a lot of clients who, in the vein of understanding and optimizing for taxes, have started tax entities through our tax strategists that we work with for a lot of them, or through their own tax strategists, but they now have, whether it's a real estate LLC, maybe it is consulting, maybe it's what they're flying and they're teaching pilots, going through the ATP, but a lot of them have started taxable entities. So you're a small business owner, you're primarily W-2, or in my case, I'm fully 1099 small business owner. For us, how can we implement this? Can we? What is the restrictions? How should we size the policy? How does that conversation look? Another one, high net worth. I want to gear this episode specifically to two dudes, and hopefully all of us should be striving to have an estate tax problem. I only have two clients with estate tax problems currently, right? I hope
Mhm.
all of us get there. I want that. That's a good problem to have. For a high net worth, and specifically, I'll kind of use these two guys. Like, how could we use this for them, so that I can send it to them and say, like, this, you need this, right? Another one on estate planning, and then I want to do, like I said, the stock versus life episode, or stock and life. Like how these are not conflicts, but how. And I think we hit on a lot of that, so that could be kind of tied into our back and forth on the retail versus wholesale strategy, how you position it, how you have that conversation, and then as we were talking, I thought it would be good to maybe do a or 3-person episode if we could bring on our tax strategist, because I would love to implement this for Remnant Finance. I would love to implement this for my own S corp, and then our tax strategist works with a lot of our clients. So I don't know who you guys use as a tax strategist, or it's just you work with all of them. But it'd be cool to kind of have this like dialogue with because you have that document for the CPA, which we'll link in the show notes. How do we implement this? But it'd be cool to have that conversation on a podcast if that's something you're open to as well.
Yeah, let's explore these. I mean, we'll grab some time offline. The estate planning one, I'd probably bring in another expert. I'm very good there, but if people want technical stuff, then there's areas where I have expertise, and then there's areas where we all need to be humble enough to say, let's partner with somebody else, right? The stock versus life is an interesting concept because I don't view them as a dichotomy, so that may not be as polarizing to drive traffic, but I view them as 2 + 2 is 5. And so instead, that episode I think would be really fun because I can share some of my knowledge on portfolio construction from the multi-billion-dollar level, and how I would design a portfolio to enhance whole life, and how whole life enhances a portfolio. I think anybody positioning them as a dichotomy, um, I don't know. I just don't. I don't view it that way. So yeah, we should jam out again. But thanks for having me on the show. It really means a lot. I'm glad we've connected, man.
Yeah, me too. And thank you for this record setting for us podcast length here. I really appreciate it. I'm looking forward to more discussions.
Thanks.
I hope this provides value. We're going to have links to book with you guys if you want, or you can just reach out to us. We'll link you up with Ro. Owner's Asset. We'll have the handbook in the show notes. Thanks, man. We'll see you. Cheers, everybody.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.